Good morning, everyone. Welcome to Squawk Box Asia. I'm Chery Kang in Hong Kong.
Good morning, folks. I'm Martin Soong. Let's get a look at your headlines at this hour. So stocks stateside tumbling overnight. Mag 7, NASDAQ, crypto. Investors de-risking out of big tech and AI, which has, of course, been leading the market higher most of this year, getting jittery, possibly ahead of Jackson Hole on Friday. What if is the question. Fed Chief Jay Powell is more hawkish than markets are pricing.
White House is stepping up its tariff pressure, extending the 50% levy on steel and aluminum to more than 400 additional product groups, hitting rail cars, construction equipment, and heavy machineries.
Meantime, U.S. Treasury Secretary Scott Bessent accusing the billionaires behind India's giant conglomerates of war arbitrage, buying cheap Russian oil, then on-selling processed product, telling CNBC it's not the same as what China is doing.
India is just profiteering, or they are just profiteering. They are reselling. They've made $16 billion in excess profits, some of the richest families in India. So this is a completely different thing.
Good morning, Chery Kang. So what's going on with the AI trade?
Yeah, being tested again. Good morning, Marty. Good morning, everyone. And obviously, everyone is asking, is this a nice, healthy pullback in markets after that good run in recent sessions? Or is this the start of yet another AI trades being tested? And of course, is this something more fundamental? And obviously, a lot of stress out there, right, ahead of the Jackson Hole meeting later on, of course, this Friday. But let's first recap Wall Street's actions overnight. The major averages closing broadly lower, partly due to the rotation out of some recent big winners. The Dow, the only one marginally in the green. A NASDAQ composite, the biggest loser, of course, at the tech-heavy index there, down nearly 1.5%. The risk-off mode also hitting cryptocurrencies. Bitcoin pulling back after topping all-time highs of over $124,000 just last week. Right now, 113,000 is what we see there. For Ethereum, 1428, but still above that key 4,000 mark there. Crypto-linked names also having a very bad time. Strategy, previously known as a MicroStrategy, of course, the holder of the biggest corporate Bitcoin treasury, slumping more than 7%. There is one bright spot, though, in the tech space. Intel surging nearly 7% after getting a $2 billion lifeline from Japan's SoftBank Group. Marty?
Yeah, and of course, the Trump administration is talking about taking a 10% stake in ITC as well. So overnight, ITC was strong. Talk more about that later in the show. But a lot of other chip names, though, they got slammed overnight. Take a look. AMD down to about 5.5%. AI darling NVIDIA also losing about 3.5%, despite reports the company is developing a more powerful chip than the current H20 processor that is selling to China. It's called the new B30A, and it's said to be a less advanced version of the Blackwell B300 design, which is blocked from sale in China by export restrictions. NVIDIA not the only megatech name selling off overnight. All members of the Mag 7 finishing in the red, as you can see there as we pull out. Meta down sharply again. Investors selling off shares of Facebook and Instagram's parent on concerns about its pricey AI efforts. And AI software provider Palantir slumping for the fifth session in a row, down more than 9% in trade overnight. The stock, though, has doubled this year thanks to AI enthusiasm and also success scooping up government contracts. But the AI hype certainly looks like it's getting tested. Even Sam Altman, one of the leading architects of the AI boom, OpenAI, of course, hinted that things may have gone too far. The OpenAI CEO comparing today's situation to the dot-com bubble of the late 90s in an interview with The Verge, warning investors have been overexcited and may need to brace themselves for disappointment. What do you think, Chery Kang?
And I think it's definitely bad timing for Sam Altman to say that when the market is just very stressed out. Obviously, ahead of the Jackson Hole speech by Jay Powell, and when the overall market is really stressing out over growth versus inflation trade-off, and now we've got Sam Altman sort of throwing cold water or hot water over this AI trades here. I think some parts of AI space could be looking bubbly or a little too crowded, let's call it that, because we've got trades like copper, power transformers, cooling, semis. They had a good run, but what went up must come down, but that doesn't mean the whole AI narrative is dead, right? So let's see. I think it's really the timing issue for the markets.
Yeah, it could be, right? And there are cycles. What comes up must come down. There's gravity as well. But, we're going to be talking a lot more about what SoftBank is doing a little later on in the show. That's the story that CNBC's Lin is working on feverishly right now. You mentioned SoftBank taking that $2 billion bet or investment in INTC, plus the Trump administration is looking at taking a 10% stake there through I guess a swap of chip grant money for equity. So it seems like even though SoftBank has been criticized for being late to the AI party, it seems to be trying to make it up pretty quickly. It's not just INTC, right? You've got Stargate, you've got a number of other very significant and heavy AI investments on the part of SoftBank too. So Martin Soong is still bullish AI, it looks like.
Yeah, and Intel's overnight trade definitely shows that sovereign put for the company, right? And we heard from the Trump administration. We have been hearing from the Trump administration basically onshoring of some of these key materials, chips that they need to make in the United States. And if that's the idea, then perhaps the whole valuation around Intel should be thrown out the window and really look at things from, through the geopolitical lens as well. Although some traders, Marty, did talk about what led to that pullback in overnight session. Some were talking about this, MIT unit researchers talking about how 95% of organizations are getting zero return from their investments in generative AI. So maybe research like that could spook some people out there. And this is something that we've been talking about for some time now. Monetization. Maybe we're not there just yet. Maybe we're still in the cycle of scaling up, and maybe the capex is the trade at the moment. But I think, some confused traders out there really trying to figure out where in this AI cycle that we're right now.
Yeah, I mean, it always happens, right, in every sort of investment cycle. At some stage, there's got to be payback. There's got to be show me the money. We may not be quite there just yet. Listen, so, Chery, we're going to be talking a lot more about what SoftBank is doing. We've got Atul Goyal, Managing Director at Jefferies Asia. He's going to be joining the show coming up at 8:30 a.m. Hong Kong, Singapore time. So looking forward to that conversation. Meantime, let's move on to another top story this morning. The U.S. expanding the scope of its Section 232 tariffs on steel and aluminum to more than 400 additional product categories. The new tariffs are going to hit everyday items, including car parts, machinery, also rail cars. The Trump administration aims to shut down loopholes and also bolster U.S. steel and aluminum industries. But economists, though, warn the tariffs could strain supply chains and drive consumer prices, higher. Analysts estimate the duties now cover at least $320 billion worth of imports, adding new inflationary pressure to the U.S. economy. Chery?
And as we head for a break here, here's a quick look at U.S. futures right now. As we pointed out at the top of the show, we did see some pullback. Futures, I know we've got hours to go, but showing some recovery. We'll see how things go there. We'll dig deeper into what's driving the markets with Jim Karen from Morgan Stanley Investment Management. That's coming up next. Squawk is back in 2.
Welcome back. It's a midweek Wednesday here on Squawk Box Asia. Let's get a look at the Treasury market and show you how yields are pricing the benchmark 10. We've picked up. We're at 431.01. The short end twos at 75.43. CNBC's Rick Santelli with the full bond market report. Take a look.
Good morning, Asia, Australia, New Zealand. Well, we did have data today. We had our July look at housing starts. They were up solid 5% plus. Permits, preliminary look, wasn't as exciting as starts. They were down a couple and a half%. Tomorrow, we have the minutes to the last Fed meeting, but no data points outside of the weekly regular MBA mortgage applications. It's always interesting, of course, to see what the average 30-year fixed is across the country and see if we see any pickup in applications. If you recall, last week applications jumped almost 11%. And we did see some of the lows of the recent range in mortgage rates, but that still represents a level above 6.5%. As for Thursday, of course, we'll get more data, initial claims, which may be the most important number this week, especially after what we've seen in warmer inflation and cooler labor markets. As for the markets today, the focus seems to be Jackson Hole coming up, and interest rates were very calm. The dollar index on pace for a 6 range of closes within less than a half a cent. And the equity markets, well, there is volatility there. Just look at the NASDAQ today, off almost 1.5%. But that equity volatility, even though it seems to alternate from which index it concentrates in, it's been different in the fixed income markets. Everything seemed to have changed with respect to the nature of the trade after the July 30th Fed meeting. Opinions have changed. Confusion over is an ease coming or is an ease not coming? Will there be a lot of Fed guidance trying to take away what is a fully priced quarter-point cut at the September meeting? Reporting from the CME HQ, I'm Rick Santelli, CNBC Business News, Chicago.
Jim Caron is the Chief Investment Officer of Cross Asset Solutions at Morgan Stanley Investment Management, joining us live this morning. Jim, it's great to have you on. So, Cross Asset, did you see any pockets of the markets, any space that looked bubbly to you?
Well, good morning. Thank you for having me on your show. Well, I don't think it's any surprise that the narrowness of the equity markets has been largely in these large cap tech Mag 7 type names. And I think what we saw today was a little bit of a repricing of that. And we started to see a rotation. The Dow was up today, and the NASDAQ was quite a bit down. The broader S&P 500, the other 493 outside of those 7, actually did reasonably okay. So I don't think that it's necessarily bubbly. I just think that there has been a lot of narrow focus on a very small sliver of stocks. And I think we're starting to see some of that correct at this time. But we also have to recognize that these, that these equities are up quite a bit. So I don't think today is anything more than really just a technical readdressing of some of the rotation. So right now it's too soon to say anything more than that.
Yeah, and what's going to give us some clues in terms of where the market goes? Is it Jackson Hole? And how are you recommending to position around this? Because the big question is, does the U.S. economy need more easing down at this point in time? What do you say?
Yeah, so I think it's really a question about the labor market, and I think there's something called reflexivity, which means that if the labor market starts to slow down, it would likely slow down very quickly. It wouldn't just be a slow turn. So effectively, what I think that Chair Powell is going to address is that risk that the labor market's slowing down. This is not new news. We know that the quarterly census of employment and wages, the QCEW data, has been revising numbers down quite significantly. This is coming up again on September 9th. There's going to be a release of that. The jobs data over the next several months is going to be weak, and there's no question there. So I think the Fed is in a very difficult position because I think they need to cut interest rates in order to address the softening of the labor market in terms of the run of data that we're likely to see. On the other hand, we still have some inflation concerns and some inflation worries, which may give the Fed a little bit of pause. So I'd say that the Fed opens the door at Jackson Hole to rate cuts. They create a pathway to do that. There's going to be a labor report and an inflation report before the Fed meeting. But providing that those aren't overly surprising, the Fed's going to cut.
It looks like, and the Fed will eventually get on board with this. It seems that you're suggesting here, but what the Trump administration is going for right now, they're trying to embrace the whole AI-induced productivity gains, and then tolerate this three-level range for inflation because AI is going to be deflationary tomorrow in the near future. Is that the narrative going for the Trump administration that the Fed will have to embrace eventually?
Yeah, that's a great question. And I think this really gets to the heart of the matter here. What we have to understand is that with current policy, and this is mostly coming from the Trump administration and fiscal policy, that there are three components to this. One is tariffs, right? So tariffs, no question, tariffs are a negative. They're a tax on profit margins. It increases inflation. We all know that increases costs. But there are two other components of their policy. One is deregulation, and the other is the tax and budget plan that they've put forward. Now, both of those are cost reducers that are there to face off against tariffs, which increase costs. So exactly to your point, there's a tug of war, which one wins? And ultimately what the market is basically saying is that with the tax, CapEx, accelerated depreciation, that there's going to be a lot of business investment, and there's likely to be a lot of hiring from the private sector this time around, not the government sector, but the private sector, that this could increase productivity going forward, and it could keep inflation relatively well contained. Because remember, the number one cause of inflation is usually wage inflation. Right now, we're seeing the government sector, the public sector start to shrink, and that's what's bringing down a lot of these numbers in terms of the employment numbers. The private sector employment over the last 2 years has been flat to down. So there's going to be a lot of labor coming into the markets over the next several months next year that's going to be competing for these jobs. So that means that wages may not tick up as much and create that inflation. So that gives you that higher productivity potentially going forward. And I think that's what the markets are effectively betting on. So we have to really look at the whole package of these things, and it's exactly the way that you framed the question.
So, Chair Martin here, great to see you. Always a pleasure having you on the show. Bottom line, Jackson Hole Friday is you think that Chair Powell is not going to push back, is not going to come out guns blazing. And is that because, it's almost inevitable, right? At some stage, it's going to show through in the data, inflation as well as weakness in the job market. Plus, you got to think about number of seats that are going to come open and the appointees, which are likely to be the president's men coming down the road. So, is he going to basically just go with the flow then?
Well, his topic at Jackson Hole is going to be a Fed framework review. This hasn't been done for 5 years. So what does that mean? What it likely means is that the Fed is going to start to think about average inflation targeting, and essentially highlighting the fact that inflation, if you go back over the past 10 years or so, has been below target for an extended period of time. Recently, since COVID, inflation's been above target for the past several years. If you average it out over a long period of time, we're likely still around that level of inflation that's close to target. Now, why that's significant is because it means that despite the fact that inflation is higher than target today, around 3%, like 2.8, 2.9% relative to the 2% target, that the Fed is still willing to cut interest rates because they're looking at an average inflation targeting. So what that means is that this is opening the door for the Fed to cut interest rates in September and maybe a couple more times this year, despite the fact that inflation is above target. And we also have to recognize that the jobs market is also going to be likely softening as well. And I think that's going to be the statement. That's going to be what's behind the paper that he reads and his assessment of the framework review.
Okay, we'll have to wait to see what it says on paper there. So you're suggesting that, look, the Fed's dual mandate, they're leaning more on employment and less worried about price stability. But I mean, when you take a look at whose job is this, right? It's usually for inflation, that's the Fed, right? When it's the budget, fiscal prudence, etc., it's Congress. These days, though, it sounds as though those roles have been reversed, or rather, the Trump administration is trying to reverse those roles, going, look, inflation, that is something that we'll handle. We've got the big, beautiful bill and government debt, et cetera. Yes, it's rising. We'll just inflate our way out of it as opposed to growing our way out of it. But, for the Fed, it's a different job.
Yeah, no, that's exactly right. So I think what is trying to be done here in terms of, I mean, the Fed is ultimately going to be responsible for inflation, but you're absolutely right that there's a lot more incentive from this administration to try to get inside Fed policy and try to get those front end rates lower so that basically the U.S. government can fund and finance their debt at lower interest rates, closer to the front end. That ultimately, though, is being noticed by the markets. And the way it's being noticed is that the yield curve is starting to steepen again. And we're starting to build in a risk premium back into the yield curve. So the yield curve is still flatter than average. Like the 2s10 spread, 50, 55 basis points. The long-term historical average of the 2s10 spread, the difference between the 10-year yield and the 2-year yield, is usually somewhere around 75 to 100 basis points. So essentially, the curve is likely going to re-steepen under this policy, and it's increasing this risk premium that's likely going to come into the markets as well. And that's the way the markets are thinking about this. But Martin, you're exactly right. This is an interesting role reversal where the federal government is trying to control inflation to some degree and also lower interest rates. And the Fed is trying to be responsible about how the debt in the U.S. gets paid off, which is not exactly the way it's supposed to work.
Yeah, it's these are unusual times that we live in. So, in terms of the shape of the curve, we talked about this offline a couple of seconds ago. What seems to be happening right now is bull steepening, right? If the Fed inevitably is going to have to start getting back to cutting, I know you were looking for, as are most people, right, a cut at the September FOMC and maybe another 2 to come before the year's out. What happens next year, though?
Yeah, that's the key question. So what the market is basically saying is that you're likely to get about 5, possibly 6 rate cuts in total. I think that's a little bit aggressive. I think that the Fed could cut interest rates maybe 2 times this year, maybe 3 times this year, and then maybe one more time in 2026. And that would likely, I think it's going to be marginally more difficult for the Fed to continue to cut interest rates going forward into 2026, because I still think that inflation is likely to stay, above target for an extended period of time. I think we're living in about a 3% inflation world. That's the way it was in the 1990s. That doesn't mean it's bad for equities. It doesn't mean it's bad for growth. It just means that the hurdle rate to generate growth is going to be more expensive, and it's just going to be a little bit higher. So ultimately, I think it's going to be harder for them to cut rates aggressively in 2026.
And in that environment that you're expecting, what is a good split here? And obviously, 60-40 portfolio sounds like something that used to work a long time ago. Are you thinking about privates, gold, or some were talking about Chinese yuan as well. Just talk to us about an ideal portfolio, a good split to have right now.
Yeah, so the key thing that everybody has to deal with that's thinking about financial assets in a balanced portfolio, diversified portfolio, is today that correlations between bond returns and equity returns are very high. So what we're trying to do is reduce those correlations, which by definition means that you get diversification. So if bond returns and equity returns are very highly correlated with each other, it's not like adding more bonds will reduce the risk in the portfolio anymore. So what people are starting to do is they're starting to add other asset classes to their portfolio beyond just stocks and bonds. One of them is alternatives. Alternatives has almost a bond-like characteristic to it in the sense that you invest in it. It's a longer-term gain. It's not as volatile over time, and in theory, it gives you nice stable returns, and that can reduce the correlation. So yes, adding alternatives to a portfolio can certainly be helpful, and it can dampen the volatility while still keeping the overall run rate of returns high. Currencies are a bit challenging, right? Because the correlation between currencies, whether it's the dollar yen, the yuan, the euro, whatever it is, the currencies, the correlation stability of currencies relative to stocks and bond returns flips all the time, and it's very unpredictable. So very, very hard to do it with currencies.
Gotcha. Jim, always great value talking to you. Appreciate it. Thank you. You keep safe. Do it again very soon. Jim Karen there from Morgan Stanley Investment Management joining us live. We'll take a quick break. Squawk Asia is back in 2.
Welcome back. It's 7:30 a.m. in Singapore and here in Hong Kong. The SGX and Nikkei futures have just come online, and let's take a look at what's in store. Some pullback that we're expecting to see here. Futures indicating down about a couple of 100 points there. And we've got the dollar yen at 147.72. So the dollar is coming back up a little bit versus the Japanese yen this morning. Marty?
All right, let's get a look at how oil is pricing early Asia on a Wednesday. Bring up the charts. You've got front month NYMEX top of your screen at 62.60. That's up about 0.4%. Looking bid. Brent, the global gauge, it's at 65.79. Overnight, we had U.S. Treasury Secretary Scott Bessent accusing India of profiteering from cheap Russian oil purchases, saying that wealthy Indian families that are lining their own pockets by reselling Russian crude at a profit. Telling CNBC it is not the same as what China is doing. Take a listen.
pre-22, pre-invasion, 13% of China's oil was already coming from Russia. Now it's 16. So China has a diversified input of their oil. If you go back and look now, I believe India had less than 1% of their oil, 1%, and now I believe it's up to 42. So India is just profiteering, or they are just profiteering. They are reselling. They've made 16 billion in excess profits, some of the richest families in India. So this is a completely different thing. Like this India, what I would call the Indian arbitrage, buying cheap Russian oil, reselling it as product, has just sprung up during the war, which is unacceptable.
All right, let's get value add. Bring in Michael Kugelman, Senior Fellow at the Asia Pacific Foundation, joining us live out of, looks like it's D.C. Michael, great to see you and appreciate your time and a pleasure having you on the show. So, when I first heard Secretary Bessent's comments, my first thought was, boy, it doesn't look like that 25% tariff, secondary sanction tariff on India for buying cheap Russian oil, it doesn't look like that's going to come down anytime soon.
Yeah, that's true. Not only that, we learned a few days ago that the U.S. has canceled scheduled trade talks with Indian negotiators, which were meant to take place next week, which of course is right around when those 25% tariffs are expected to kick in. So yeah, it seems unlikely that India will avoid that worst case scenario of the total of 50% tariffs kicking in within the next few days.
What do you make of the Secretary's description of what India is doing as war arbitrage or profiteering? Because, if you were to take a slightly longer historical lens and also look at it more impartially, you could think that, it'd be fair to say that, look, guys, this is just business, right? This is what happens. I buy low and sell high. That's one. And two, by the way, India would probably remember these oligarchs, not oligarchs, but I guess over there they're called crony capitalists, right? The Mukesh Ambanis of the world would remember that during the Biden administration, it was the U.S. that was pushing India to buy Russian oil in order not to have prices spike. So, they're probably pretty confused in India right now.
Yeah, they're confused, they're angry, they're many things. But you're absolutely right that the U.S. ambassador to India during the Joe Biden administration, publicly on the record said that India was doing nothing wrong, and that indeed by importing all this cheap oil from Russia, it was stabilizing oil markets. And clearly, the current administration has a different view. Well, look, as a longtime analyst of U.S.-India relations, it's quite jarring and striking to hear a senior U.S. official use this type of language, profiteering, totally unacceptable when referring to any type of Indian policy. I think that for so long in New Delhi, there's been an expectation that U.S. officials would treat India with the respect that one would expect for a top partner. But clearly, these are different times. Now, when Bessent talks about rich Indians, families benefiting from all this, I'm not exactly sure what he means by that. Yes, there is one very rich man, one of the richest men in the world, Mukesh Ambani, who heads Reliance Industries in India. Yes, I mean, his company has ramped up oil imports from from Russia in a big way since the Russian invasion of Ukraine. But this is just one figure, one oligarch, one person. And, India's argument from the start has been that it started importing all this oil after the war began because it was cheap. And when prices went down, that's when it decided to ramp up its imports from Russia. Bessent is correct that before the invasion of Ukraine, India was not really importing much oil from Russia, but that's because the costs weren't as low. And in fact, if you go look at 2021, the year before the Russian invasion of Ukraine, India was actually the top destination for American oil. India was ramping up imports of American oil at the time, and it was using that, justifying that as a financial decision. So I think that the argument that Bessent is making here is one that one could easily push back on, and certainly in India, it has really deepened a significant crisis in the bilateral relationship.
Yeah, Michael, it seems strange, right? India's become sort of flavor of the day whipping boy, all right? And I wonder how much of that is because, look, you could think that you might think that, the Trump administration, the last thing they want to do is to back China even more into a corner, right? By slapping tariffs on them, secondary sanctions on them for buying cheap discounted Russian oil. But interesting, we were showing the chart just a couple of seconds ago, probably worthwhile bringing that up maybe in a three-way so viewers can follow along. To Secretary Besson's point, India has now overtaken China as the biggest buyer of Russian crude. It used to be the other way around. So I think there is something there. But I mean, for China, Besson's argument is, look, it's different because they were already big buyers of heavily discounted Russian oil even before the conflict, which is also true. So I guess I'm getting the question: is it out of the realm of possibility that the Trump administration could turn around and finally, after having literally no choice, have to put secondary sanctions on China as well?
Yeah, I mean, that certainly is a possibility. It seems that the administration is being much more cautious with China than it is with India. I mean, my view is that the president might be upset with the Indian government for how how he's been treated by it. For example, not letting him take credit for playing a role in a ceasefire that ended the India-Pakistan conflicts. I think it may be a bit personal for him, and that might be why he wants to go after India in particular. And also, I mean, President Trump, I think, is reflecting the fact that he respects the Chinese economy for what it is, something that is such a powerful player on the global stage. And I think at one point, not too long ago, Peter Navarro, a top advisor to President Trump, when asked about why China is not getting this type of treatment that India is, he essentially suggested that the U.S. would not want to do anything that could hurt its economic interests. But I'll say this: one could never rule out something different happening down the road. But clearly, for the president, this all comes back to his pressure tactics that he is trying to use against Russia to get Russia to agree to a ceasefire. And for various reasons, he has, as you've noted, essentially turned India into a punching bag. And the White House spokeswoman today said that very specifically. She said that we're applying a lot of pressure on Russia to try to end the war. And then she said right after that, she mentioned the tariffs. She used the term sanctions that had been put on India.
Yeah. And Michael, do you think this could eventually push India closer to China and Russia? I mean, I know that sounds very, sort of this traditional geopolitical playbook here, but how does this sort of reshape things, or does it not, in Asia when it comes to, security alliances and what happens to the Quad's strategy coherence?
Yeah, I mean, there's been a lot of talk recently about how India is signaling that it wants to move closer to China. And, as you know, the Chinese foreign minister has been in India, and he met not only with his Indian counterpart, S. Jaishankar, but he also met with Prime Minister Modi, which is quite striking for a foreign minister from another country to meet the Indian Prime Minister. But India has actually been trying to ease tensions with China for quite some time, going back a number of months, even before President Trump, before Trump came back to power. And I think India recognizes that China is important for India's economic interests. It believes that if it could increase the amount of Chinese investment coming into India, that could be a big boost to some critical industries in India that have suffered, like manufacturing, among others. And after a border clash back in 2020, India decided to subject any new Chinese investments into India to scrutiny. And so I think that, India recognizes that there could be some economic reasons for wanting to ease tensions with China, but certainly what's happened with the U.S.-India relationship recently, I think, has made India even more inclined to try to open things up more with China, to try to hedge against all the uncertainty surrounding the future of the U.S.-India relationship. And as for Russia, that's a very special relationship between India and Russia. And it's not something that I think we could say that it's going to get stronger now. I mean, India and Russia have had, that's been a very consistent thing in terms of India's foreign relations. Though I would say that soon before the Russian invasion of Ukraine, you were seeing India slowly reducing its share of Russian arms relative to the arms it was importing from the US and other key arms partners like France and Israel.
Yeah, and one more question regarding India, China cozying things up here. And you point out that it has been happening for a while now. And we're also tracking, of course, the Chinese Foreign Minister Wang Yi's agenda in New Delhi this week and today as well. Do you think, by China addressing some of the key concerns economically for India, like rare earths and fertilizers, do you think that's going to really make it tougher for Washington to get things in order with Beijing and New Delhi separately?
Yes, absolutely. I mean, that would be a big deal if that rare earth issue was worked out. That would be a big boost for India-China relations at a moment when that relationship is already enjoying a lot of momentum. But that said, I don't think we should go too far. I mean, India and China remain strategic competitors. They've got a long disputed border that's been the site of many clashes. There's a lot of distrust baked into the relationship for that reason. And China continues to have a deep alliance with Pakistan, India's arch rival. So I think it'll be difficult to get around those issues, even if we see improvements in the relationship in other areas.
And what do you think Wang Yi's main agenda is? Is it really sort of working with that window that's sort of left open between India and the United States? Although you've been pointing out that it's been really in the works for some time now, but for this visit to happen in the month of August in 2025, when all these trade negotiations are happening fervently, what do you say?
No, I think the Chinese foreign minister is clearly capitalizing on all the tensions in U.S.-India relations. Sees an opportunity and wants to seize it. I think it's as simple as that. Though, again, we've seen a lot of high-level engagement between India and China over the last few months, going back to before the U.S.-India relationship started going downhill. So, there are other motivations here for both New Delhi and Beijing that are separate from the state of U.S.-India relations.
Let's say India doesn't budge when it comes to the whole Russian oil imports. What happens then?
I mean, you have to worry about the economic impacts for India of being slapped with 50% tariffs. I mean, as you know, the U.S. is one of the top destinations for Indian exports, particularly textiles. And if you look at India's export competitors in its own neighborhood, Pakistan, Bangladesh, further afield, Vietnam, their tariffs are much lower than India's. And so that could really help them when it comes to textile exports. So I think India is going to continue to try to find more market access elsewhere. It's been trying to get a trade deal with the EU for quite some time. The EU is another critical export destination for India. I think it's going to look to try to speed up those talks and hope to get a deal before the end of the year to reduce some of the potential damage from the U.S. tariffs.
So, Michael, we'll see what happens at the end of the month when Wang Yi arrives in India, right? Whether or not China is going to take advantage of this opportunity of this, I guess, looks like widening rift between India and the U.S. But we understand that the official agenda is going to be, look, guys, we got to talk about this old border skirmish high up in the Himalayas where the air is thin and where your side and my side, we ended up using rifle butts and clubs to try and kill each other. How emotive an issue is that? And do you think both sides are going to be able to get over something like that, right, the border clashes, in order to talk about cooperation?
Yeah, I mean, that remains an emotive issue for sure, but not as much as it had been soon after it happened. It's now been more than 5 years since that horrific clash. And, it is notable that you've had senior military officials on both sides meeting to hold dialogues very frequently since 2020, since the clash happened. So, I think the more the time has passed, the easier it's been to discuss it. The fact that the two countries got a border deal last October, which restored patrols along the part of the border that was the subject of the clash, that's really helped as well. And it is also notable that Prime Minister Modi, in a podcast interview back in March, again, this is before U.S.-India tensions got worse, he essentially said that the border has been normalized, which is a pretty strong term to use. Now, the border, it's a very long border. It remains mostly disputed. But that language coming from the prime minister suggests more optimism on the part of the Indian government that the two sides can start to work things through. So, yes, those types of discussions will always be sensitive. But I think given how things have improved on other fronts in India-China relations recently, it'll be a bit more easier to carry out those difficult negotiations and, from their sake, hopefully make some progress there.
Yeah, and aside from their history of border clashes up in the Himalayas, right, there's this whole question, very fundamental strategic question of trust between the two sides when you've got China arming Pakistan, India's archenemy.
Yeah, this is exactly it. The fact that China has this deep alliance with Pakistan imposes significant constraints on China-India relations. And indeed, in the recent Pakistan-India conflict in May, it was the first time that Pakistan inducted Chinese weaponry used against India in combat operations and did a significant amount of damage as well. There's strong indications that several Indian jets were shot down by Pakistani jets. So yes, I mean, that certainly remains a problem. The India-Pakistan relationship now is more tense than it's been in decades. And that's going to figure into the calculus here for India as well. I mean, there's only so far it can go with China, so long as it knows that Beijing continues to be very close to India's arch rival.
And both for China and India, Michael, right? I mean, the whole idea, the bigger picture is that these Western sanctions on Russian oil is not really working. Isn't that really the point that we need to take away from this whole thing?
Yeah, that's correct. And from India's perspective, the entire U.S. argument is double standards and hypocritical in the sense that many European countries are still importing from Russia, including energy. And according to the Indian government, the U.S. itself is still importing some goods from Russia. And, at the end of the day, the U.S. is essentially making this argument that Indian imports of Russian oil are funding the Russian war machine, even though India has been a relentless critic of the war. It's been calling for an end to the war from the time it started. Modi's one of the few world leaders to actually publicly tell Putin, while Putin was sitting next to him, that the war needs to end. So that's another thing that's really got a lot of folks upset in New Delhi and across the wider Indian public.
Yeah, and, folks are basically pointing out that Trump is rolling out red carpet for Putin and really playing up the whole trade negotiation with Beijing at the moment. And then a lot of attacks on India. How do you read the whole power dynamics, perhaps within the Trump administration, their agenda, their strategy regarding three different countries?
Yeah, I mean, many expected that Trump would take a less hardline position toward Russia than did the Joe Biden administration. There's been a bit of surprise that he's been so hard on Putin, but I think that's really part of the pressure tactics to get Putin to agree to end the war, because that's what Trump has wanted to do. One of his top priorities since he came to office was to be able to be seen as that leader that compelled Ukraine and Russia to move toward a peace deal. China's complicated. The Trump administration has not yet come out with a clear, coherent policy toward China. Sometimes it seems like it wants to compete with China economically. Other times it seems like it wants to reach some type of understanding or a détente. India is the most surprising of any, just because we'd seen for several decades, including during Trump's first term, very strong relations with India. And Trump is a genuine supporter of partnership with India. But I think that India has been victimized by these pressure tactics that the Trump administration is trying to carry out. Trump is clearly using tariffs as a pressure tactic against Russia. But finally, to go back to something I said before, I do think that one of the main reasons why we're seeing such criticism towards India from the president is that he feels aggrieved. He doesn't like the way the government has treated him. He doesn't like that Modi's not letting him take credit for playing a role in that India-Pakistan ceasefire. He feels that he doesn't like the fact that he had a long phone call with Modi back in June when Modi took a lot of time telling Trump about how wrong he was about a number of things he had said about the India-Pakistan conflict. And there are a number of other reasons why I believe that Trump is aggrieved with India. It's not the only reason why we're seeing such of a turnaround in the U.S. approach to India, but I think that is part of the story for sure.
Michael, thank you so much for joining us. A great conversation. That was a Michael Kugelman from the Asia Pacific Foundation. And later on Squawk Box this morning, Inside India's anchor Sridhar Garaja is going to be digging deeper into the story as well. Squawk is going for a quick coffee break here. We're back in 2.
China's central bank will publish its loan prime rate this morning at 9 o'clock. Taiwan export orders due this afternoon. In corporate earnings, we hear from Hong Kong Exchanges and Clearing, Henderson Land, Chery Properties, and Baidu among those reporting today. And Huawei-backed semiconductor materials company SICC makes its debut in Hong Kong this morning. Priced near the top of the range, the retail portion of the stock was more than 2,400 times oversubscribed.
We'll get more insight into the state of the American consumer when retail giant Target reports earnings before the bell, along with home improvement chain Lowe's and TJX Companies. That's the parent company of TJ Maxx. Also on Wednesday, the Fed will release the minutes from its July meeting. The central bank kept the benchmark borrowing rate unchanged despite intense pressure from the Trump administration to make a cut. Plus, Fed Governor Chris Waller will speak at the Wyoming Blockchain Symposium ahead of Fed Chair Jerome Powell's highly anticipated remarks in Jackson Hole on Friday. And finally, Google is expected to launch its latest hardware at its Made by Google event in New York City. The tech giant is expected to unveil a new slate of Pixel phones and other devices.
The Reserve Bank of New Zealand's rate decision is due out at 10 a.m. Singapore, Hong Kong time today. Economists expect the central bank to lower its official cash rate by 25 basis points to 3%, taking the benchmark to a 3-year low. New Zealand is grappling with an uptick in unemployment rates and mounting economic tensions, plus that 15% U.S. tariffs on all New Zealand exports.
Oh, yeah, there's that as well, huh? Right, stay tuned. We've got market opens ahead for Tokyo, Seoul, and Sydney when Squawk comes right back after this.
Good morning. I'm Chery Kang in Hong Kong.
Good morning, folks. I'm Martin Soong. These are your headlines at this hour. Working with kind of a weak lead from Wall Street, the Mag 7, NASDAQ, crypto all tumbling. Investors de-risking out of big tech and AI, which of course has been leading the market higher most of this year, getting a little jittery ahead of Jackson Hole on Friday.
We're keeping tabs on Japan's SoftBank Group after its sell-off yesterday. The company has big tech investments under its Vision Fund and could come under some pressure following the sell-off in U.S. AI and tech plays overnight.
Data out this morning showing Japanese exports falling for the third month in a row, dropping more than expected, in fact, signaling the pressure that the country is facing amid tariff concerns.
Markets in Japan, South Korea, and Australia just coming online. And let's take a look at how they are opening up trade this morning. We've got the red across the board. Kospi is really the big loser there, and it keeps on getting tested. And today is really the AI trades. And, a few days ago, it was really the tax revision and so on. But yes, we've got the Kospi down more than 1%. Other markets are doing, well, I'm going to just call it resilience. I mean, down about 0.3%. So, of course, this is slight pullback from record highs that we've seen in recent sessions for Nikkei 225 as well as ASX 200. Let's take a look at chip plays in South Korea on the back of that rotation out of tech overnight, pulling the Nasdaq down 1.5%. And we've got right across the board, and very interesting. And this is exactly what I was going to get into, because Samsung Electronics bucking the trend of the sector and this morning. What's going on here? And perhaps it's really the rotation out of SK Hynix into Samsung Electronics, and that has been really the optimism out there, and that has really played out for some time now. And then looking at that Intel story, there is that the Reuters report suggesting that Trump administration is eyeing U.S. government stakes in other chip companies that received CHIPS Act funds, citing its sources. So perhaps that's the reason why that we're seeing some bid coming through for Samsung. Remember, Samsung is really the only one in South Korea that has a foundry capacity. We're also watching Japanese steelmakers this morning after the U.S. announced that it's expanding tariffs on aluminum and steel to include more than 400 additional product categories. The new levies will hit everyday items like car parts, machinery, and rail cars. We've got, well, interestingly enough, some green across the board. Marty?
All right, about 3 minutes plus into Wednesday trade, midweek up in Tokyo. I want to show you what's going on with shares of SoftBank as well. This is how they're looking, 16,035 yen and change. No prices registered just yet, but we'll continue to track it. Yesterday, it fell sharply after announcing plans to invest $2 billion in the struggling but storied U.S. chip maker Intel. CNBC's Lynn Lin is on that story. Good morning.
Yeah, good morning to you, Marty. Well, beyond the specifics of the investment itself, which has been well covered, we're now hearing this report from the Financial Times that in the weeks prior to the announcement, Intel and SoftBank actually were in discussion for potentially the Japanese investor to buy Intel's contract chip making business as well. And obviously that has not eventuated, but this investment does not preclude something bigger happening in the future. So that is a particular watch point. What's also notable is that this investment announcement came just a week after these whispers that the U.S. government is going to or interested in taking potentially as much as a 10% stake in Intel, although most of that will come from already designated subsidies that were going to the company as well, especially, of course, when we think about the relationship between the U.S. president and Masayoshi Son as well. But of course, for SoftBank, boy oh boy, it's been, obviously quite a busy 12 to 18 months, and I believe our wonderful team has put together a bit of a graphic in terms of some of those AI and chip-related investments that Masa-san has been busy signing up on over these last few months or so. What it touches on, if you look across the breadth of these arrangements and investments, it seems is that full build out of AI, and consistent as well with Masayoshi-san's stated goals when it comes to the AI revolution. He said explicitly in the past that he believes it will be bigger than any other or all the other industrial revolutions in the past as well, and that artificial superintelligence will basically change every facet of our lives going forward as well. For Intel, certainly, of course, when we saw the impact in terms of Intel's share price as well, a vote of confidence. But, one of the key analyst views here, Chery, is that they've really fallen behind when it comes to GPUs, when it comes to accelerators. And what they need to see is a key customer and sales coming through. And that is not, we believe, part of this investment deal.
Yeah, so Intel is getting that lifeline, and I think people enjoy saying that because of all these troubles that you laid out there for Intel. But what is it for SoftBank? I mean, they must be going for some things that go beyond that $2 billion investment. And I know that it's very much in line with some of the recent investments that they've been making as well.
Yeah, indeed. I think one thing to look at potentially is the $500 billion Stargate JV, right? They're going to need a lot of GPUs and accelerators as part of that particular build out. Now, as I said, according to reports, this is a $2 billion investment. It does not come with any kind of commitment that there will be any purchases of Intel's chips, but that could be something that could happen in the future. There would be alignment there. That would give as well the Stargate project some diversification. Also, when you think about Intel, of course, it's absolutely crucial for the US advanced chip making domestic space as well. So, this could also be a move by Masa-san, who has a close relationship with the US president, to basically stay in his good books, particularly when we know that the US president is at the moment, looking at and expecting to put out those chip related tariffs as well. Look, Intel's stock's been beaten down, certainly because of all its troubles, and we're watching that turnaround plan as well. And it's also worth mentioning that Intel's CEO, Lip-Bu Tan, knows Masa-san very well because he served on SoftBank's board until 2022 as well. So I think these are some of the factors there worth considering, Chery.
Connecting all the dots there. Masayoshi Son, Donald Trump, and Lip-Bu Tan as well. But I wonder, I just can't help but wonder, what's the risk of, SoftBank being this Trump administration's sort of a private sector champion, right, in Japan, sort of being brought in to help out Intel? I keep thinking that there must be some sort of risk here, just like Jensen Huang is having a very hard time being a diplomat between the U.S. and China. What do you say?
Well, Chery, I know what you're saying in the sense that certainly there is a risk there in terms of this huge investment. It's not just the $2 billion. Also, we're going to consider this $500 billion in terms of Stargate as well. But if you look at the list of investments that we put up earlier, there's so many different things. He's very diversified now. He's built back his stake in NVIDIA. He has a stake in TSMC. He's obviously still a majority owner in ARM as well, which is also looking to branch out, potentially become a competitor to NVIDIA. He's purchased GraphCore as well, and there are big plans on that side of things. He has JVs as well domestically in Japan. So I think that certainly he has continued to increase his footprint in the US. There is no doubt about that, because he sees that as the center of excellence when it comes to advanced AI. But he is also hedging his bets with some of his other investments and JVs as well, Chery.
Yeah, thank you very much, Lynn. And to be continued, because we are going to talk more about SoftBank with Atul Goyal, Managing Director at Jefferies Asia. That conversation coming up at the bottom of this hour, so stay tuned for that. And we've got data out earlier this morning showing Japan's exports falling for the third month in a row in July, down more than 2.6% from a year ago. That's slightly more than the 2.1% drop that market was primed for, and could be due to weakness in its auto exports to the United States. But imports weren't as bad as estimates, dropping 7.5%. Now, that's better than the 10.4% decline that analysts were looking for. And we are looking at the dollar yen at the moment, 147.80. So that suggests that the dollar is coming back up a little bit versus the Japanese yen. And as we tail off into a break here, we'll leave you with a look at the biggest movers in Tokyo trade this morning. Squawk is coming right back.
Welcome back. It's a midweek Wednesday here on Squawk Asia. Let's get a look at the Treasury market and show you how yields are pricing. Bring up the charts. The benchmark 10 is at 431.01. We've edged up. Same story at the short end, too. Two's at 75.64. CNBC's Rick Santelli has the full bond market report. Take a look.
Good morning, Asia, Australia, New Zealand. Well, we did have data today. We had our July look at housing starts. They were up solid 5% plus. Permits, preliminary look, wasn't as exciting as starts. They were down a couple and a half%. Tomorrow, we have the minutes to the last Fed meeting, but no data points outside of the weekly regular MBA mortgage applications. It's always interesting, of course, to see what the average 30-year fixed is across the country and see if we see any pickup in applications. If you recall, last week applications jumped almost 11%, and we did see some of the lows of the recent range in mortgage rates, but that still represents a level above 6.5%. As for Thursday, of course, we'll get more data, initial claims, which may be the most important number this week, especially after what we've seen in warmer inflation and cooler labor markets. As for the markets today, the focus seems to be Jackson Hole coming up, and interest rates were very calm. The dollar index on pace for a 6 range of closes within less than a half a cent. And the equity markets, well, there is volatility there. Just look at the NASDAQ today, off almost 1.5%. But that equity volatility, even though it seems to alternate from which index it concentrates in, it's been different in the fixed income markets. Everything seemed to have changed with respect to the nature of the trade after the July 30th Fed meeting. Opinions have changed. Confusion over is an ease coming or is an ease not coming? Will there be a lot of Fed guidance trying to take away what is a fully priced quarter-point cut at the September meeting? Reporting from the CME HQ, I'm Rick Santelli, CNBC Business News, Chicago.
Chen Zhao is the chief global strategist at Alpine Macro, joining us live this morning. Chen, it's great to have you on. So, I don't know, the markets are looking a bit jittery, just a couple of days to go till the Jackson Hole event. What kind of event do you think this is going to be? I don't know, sparking some kind of a rate cut frenzy back into the market, or something else in the other direction?
Two things here. The first thing, the stock market has basically gone straight up. So you would expect some kind of a consolidation or correction at this level. I don't think that should be any surprise for anybody. On the Jackson Hole event, I think most likely my view is that Chair Powell is going to sound a bit of on the dovish side. The reason for that is this: if you think about the labor market, apparently the U.S. economy seems to be softened somewhat, and the labor market is, for a couple of months, the job creation has been below the so-called break-even payroll, which is about 100,000 new jobs per month. So it has been like three months or so below that. That's why the unemployment started to tick up a little bit. Nothing major, but apparently the risk, the balanced risk is tilting towards weaker economy. That's point number one. Point number two, very few people talk about that. I think that is a very important development that all the investors need to pay attention to, which is there is a pretty significant fiscal contraction going on in the United States. Everybody was talking about the fiscal deficit and things like that. But if you look at the U.S. budget deficit actually being shrinking, it have shrunk about 1 point of GDP. That is a significant fiscal contraction that from the economic point of view has to be counterbalanced by the Fed. I think that's another reason that the Fed needs to cut rates, and probably doing so reasonably quickly. So that's point number two. And point number three is that I think the inflation risk is a bit of over-exaggerated. The reason that I'm saying that is if you look at the suppliers, foreign suppliers to the United States, they are all cutting prices. Give you some numbers. It's quite shocking. If you look at Japan and Korea's auto prices in local currency terms, they have dropped anywhere between 15 to 17% since the beginning of the year. So in other words, basically, these producers are cutting taxes in order to accommodate, in order to absorb most of the most of the impact of tariffs. If you look at the U.S. imported prices from the developed world, in local currency terms, the prices actually dropped about 10%. So all I'm saying here is all these foreign suppliers are being cutting prices. That's why even though the US dollar has been quite weak since the beginning of the year, actually the dollar import prices have been flat. That's what I'm saying. If you look at the US goods prices, the goods prices have risen very, very, very slowly. That is the reason. So if you take these three things all together, labor market, fiscal contractions, and foreigners are cutting prices to accommodate the tariffs, there's not a lot of good reason for the Fed to hold the policy at this level. They need to act to counterbalance the fiscal side. Yes.
Yeah. So budget deficit shrinking. You don't have to worry about inflation right now. And we've got the Fed sort of getting a lot of pounding from the Trump administration. What kind of rate cutting cycle, what kind of trajectory do you see here? Could it be perhaps somewhat muted, though, because all these other central banks around the world, not the Fed, but central banks around the world are cutting at the moment? I was hearing that over 60 rate cuts have happened year to date.
When that happens, what happens is that the U.S. dollar will be held at a reasonably high level because everybody else's rates are coming off. That's the first thing you gotta keep in mind. The second thing here is, Powell's term is up in a couple of months, and I think the next Fed chair is going to be decisively on the dovish side. That's probably most likely the case. So I would say Powell might be doing the right thing. I think the right thing right now is to drop rates because I don't see the inflation risk being too high. I think physical contraction that are going to slow down the U.S. economy that need to be counterbalanced. So I think 25 basis point, maybe even 50 throughout the year is not a bad number to begin with. And 2026, everything is open. We don't know who's going to be the next chair, how that person will be. We have no idea. I have no idea. So I think in general, the path of monetary policy in the United States is probably slipping towards the dovish side. Not only, for at least this year for a good reason, because I'm shocked that a physical contraction is that much. 1 point GDP. That explains why the economy actually has slowed.
Yeah, so you see 25 or 50 in 2025. Yeah. Everything is open in 2026. Then which market do you believe gives you bigger upside at this level? Do you go back to the U.S. markets if you are sort of fading some of the U.S. trades?
I always thought about today's environment. If you think about today, comparing to today versus the 1990s, I wrote a lot of pieces called that sort of echoes of the 1990s. It's very similar. If you think about 1990s, monetary policy is very similar. Remember that the Fed jacked up interest rate in 94 and did so without causing recession. That was actually the first time the Fed raised interest rate very aggressively without causing recession. Before that, every time the Fed hiked rates, the U.S. economy always fell into recession. That was the first time. Now the Fed did the same thing in 2021, 22, and so far we don't have recession. That's very similar. Back in 90s, we had a dot-com bubble, we had internet revolution, we had a huge investment in the information technology at the time. Today we have artificial intelligence, we have data center investment that is going through the roof. very similar. If you look at the magnitude of investment in the data center right now, actually, the contribution of data center investment to GDP growth is very similar to consumer spending. That was quite shocking. Don't forget that the U.S. economy is basically driven by consumer spending, and data center, in terms of contribution to growth, is very similar to consumer spending. So that is very similar to, if you think about policy, market volatility is very similar. In '98, remember, the stock market dropped 20% because of the LTCM crisis, and Fed moved in and dropped interest rates 3 times. And then that basically set the stage of a parabolic move in stock prices. I think April, if you think about the decline in stock prices on the so-called tariff tantrum, the magnitude of decline is about the same. It's about 27%, and then actually the speed of recovery was basically the same thing too. So all of that basically led me to believe that the next rate cuts, I don't care whether it's twice, 3 times, whatever, monetary easing, probably going to set the stage of a pretty significant move, the final last up leg in the U.S. equity market, particularly in tech stocks. So in other words, I'm still using the 90s as a roadmap for what may happen going forward. So I'm not ready to leave the party yet in the U.S., in particular in the so-called Mag 7. I think there will be another up leg, major ones, that is going to happen. And then after that, everything is open to question. Could be a burst, could be a bust, it could be anything. But I think we're not yet. Remember one thing, last thing I want to remind your watcher, your TV audience, is that actually there's old saying the bull markets do not die of old age. The bulls are all get slaughtered by the central bank. So as long as the central bank don't raise rates, bull market usually continues. Now we're into the easing cycle, so this thing's getting a bit of a distance to go.
Okay, so Chen Zhao, just to recap, right? You had a lot of ideas there. You're seeing it's never apples to apples, right? But the closest corollary you can see to the situation today is the back half of the 1990s, 98 to be specific. Yes. LTCM crashed, Fed cut, market made a parabolic move to the upside. You think the same thing is going to happen regardless of whether the Fed cuts, I don't know, 3 times this year or 3 times next year, right? It's going to be a parabolic move higher. It's going to be led by the Mag 7 and AI. Does that mean you do not think... productivity growth. Does it mean you do not think that we are in an AI bubble, as Sam Altman has been claiming?
We are not yet. I think we will be. So bubble has to be carefully defined. If you remember .com bubbles during that period of time, the companies, as long as you call yourself .com, basically people throw money at you. The PE ratio was infinity. We're talking about the companies that are going IPOs. If you have a positive earnings, you're usually selling at a lower prices than you don't. So that is a classic sign of a fraud. And not to mention, at the time, the multiples are way higher than today. I think at the time, S&P was about 40-some times forward PE, were today 22. So we are, don't forget, and also the equal weighted index is only 18, 19 times today. So it kind of hard to call that as a bubble. But I think we're getting there. That's why next 2 years. Yeah.
I hear you. Okay, so it's not going to be pets.com. It's going to be pets.ai or something. Yes. Chen Zhao, great to talk to you as always. Thank you. Chen Zhao, Alpine Micro. We'll take a quick break. We're back right after this.
Welcome back. Let's get a quick check on markets currently trading in Asia, shaping up like this. And we did see a negative kickoff, and we see that sort of staying intact for the South Korean benchmark index in anyway, down 1.8%. So really getting tested right around that 3,000 level. Remember, the mantra for the new administration in South Korea is the Kospi to 5,000. So if you look at the sectorial breakdown, it's definitely the AI trades being tested. It's not just the technology names. That's the easy guess here, but it's the power stocks, because that's really a major AI proxy that we keep talking about in South Korea, the power transformer exporters and so on. And the rest of the region also looking negative. Nikkei 225 down 1% as we speak. Marty?
All right, so Tokyo, the broader market is down, but let's get a look at how SoftBank is trading about half an hour into midweek Wednesday trade. Bring up the chart so viewers can follow along. Shall we do that? We're not? Okay, it'll be there in just a second. Anyway, watching SoftBank for a couple of reasons. The main one, of course, is on the back of news that it is investing $2 billion into the storied but still struggling chipmaker, U.S. chipmaker Intel. That was yesterday. Okay, there you go. We've got price action on SoftBank now. 14,650 and change. That's yen. That's down, more than 8.5% under pressure on the back of that news. SoftBank says it will not seek a board seat or commit to buying Intel products. The move, though, underscoring CEO Masayoshi Son's bets on semiconductors and AI following his massive U.S. data center investments. Remember Stargate. The U.S. government is also eyeing a 10% stake in Intel, don't forget, in exchange for billions of dollars in grants under the Biden administration's CHIPS Act. Treasury Secretary Scott Bessent saying the government's goal is to stabilize the struggling chipmaker. Commerce Secretary Howard Lutnick, meanwhile, though, arguing that taxpayers should get equity from these corporate subsidies. Here is some of what Secretary Lutnick had to say on CNBC earlier on. Take a look.
America should get the benefit of the bargain. I mean, that is exactly Donald Trump's perspective, which is, why are we giving a company worth $100 billion this kind of money? What is in it for the American taxpayer? And the answer Donald Trump has is, we should get an equity stake for our money. So we'll deliver the money, which was already committed under the Biden administration. We'll get equity in return for it, get a good return for the American taxpayer, instead of just giving grants away. Donald Trump views we should get benefits for the economics that we put out. We want Intel to be successful in America, okay? We'd like an American transistor built in America, right? We'd like an American to be doing that. So Donald Trump says, hey, look, let's turn the money that Biden was going to just give away and turn that to equity for the American people. Yes, it is a worse deal than giving it away. But when you put this money in the hands of Donald Trump, you're going to get a better deal for the American taxpayer. That's who Donald Trump is, and it's obviously the right move to make.
Obviously the right move. Okay, we shall see. Let's talk about it. Bring in Atul Goyal, Managing Director at Jefferies Asia. He joins us live from across in Los Angeles right now. And my great colleague Lin is also part of this conversation. Atul, great to see you. Always a pleasure having you on the show. So, what I'm trying to figure out is, you've got on the one hand OpenAI Sam Altman saying we are in an AI bubble. Right on the other hand, you've got folks like Martin Soong committing $2 billion into Intel. The U.S. government looking for a 10% stake as well. What does it all tell you, net?
Thank you, Martin. So if you look at what Sam said after talking about the bubble, he said, we'll still do it. So we're still going to do it, and there will be players who will be investing. When it comes to Masa, what he's doing with Intel, he seems to be partnering the U.S. government, it seems. From what I see, it's very difficult for Intel to claw back its previous glory. And it's very difficult for them to compete, whether it's foundry side of the business with TSMC or even on design. So it's got a very difficult task ahead. And what SoftBank has done is, with $2 billion, it's less than 2% stake in Intel, with less than, maybe about 1% of their own market cap. So it's not a very big investment for SoftBank and for Masa.
Atul, picking up on what you were just saying in terms of what's in it here for Masa and for SoftBank, you're saying it sounds like that he's trying to continue to curry goodwill from the US president. Do you think he also believes in a potential turnaround in Intel? And do you think he also sees Intel, if that turnaround is successful, as having a potential role as part of Stargate as well?
It's not entirely impossible. If you look at his biggest investments, they've been, obviously, OpenAI is a big one. NVIDIA, another $5 billion. He has acquired Ampere, which was started and founded by an ex-Intel CEO. They have recently invested in TSMC about $350 million and another, I think, $150 million with Oracle. So all these investments, they have started in the last 3-6 months, especially in publicly listed companies. Prior to that, it was primarily into unlisted private entities, and increasingly seems to be dedicating and allocating more money around the chip industry, which is AI infrastructure, as well as application side, which is Oracle and OpenAI. Does he believe it can be turned around? Well, difficult for us to say, but if Ampere, who's ex-CEO of Intel, he's acquired that company, must have had some input into this one as well. But at the same time, if there are big investors, especially if US government is going to come along in this ride, it's possible to believe that downside might be limited at this point in time.
And, you know, so far, the market reaction has been a negative one when it comes to SoftBank. Would it have been better for SoftBank to buy the chip manufacturing unit of Intel's business? Because some reports suggest that that's what they were looking into.
That's also possible. Masa has talked about starting an NVIDIA competitor himself. And I don't know how you do that. NVIDIA has, 30 years of track record of building an ecosystem on hardware and software combined to build AI ecosystems. And Masa recently said that he wants to raise $100 billion to build an NVIDIA competitor, while at the same time investing $5 billion of his own company's money into NVIDIA. So it's very complex, but he has been investing aggressively on things around the chip manufacturing, chip design capability. Obviously, ARM, not to forget the biggest stake in ARM, 90% is that of SoftBank itself. So there are different parts of the entire AI infrastructure ecosystem in which he has invested. He was very early on the AI trade, to be honest. If you go back 10 years, he's been talking about AI investments for the longest time. And he has had some rough patches, whether it was, WeWork all in or selling Alibaba after a decade of holding it at the IPO price itself. So increasingly, he seems to be allocating more around the bet that he made 10 years back, which is AI. So all these investments are seemingly aligned with that. The biggest driver so far seems to be his investment in OpenAI for the stock to have done so well in the last 3-4 months. The last 2 days of pullback is actually part of, partly with the market correcting the, momentum stocks. So it's not necessarily just what SoftBank has done. If you look at markets correcting in US, some of the large AI investments have also corrected quite meaningfully. So it's a correction. And, SoftBank had rallied dramatically in the last 3 months as well.
What about for Intel, Atul? Because, Martin Soong taking a stake, the U.S. government considering taking a stake are both very big endorsements, I think would be fair to say. But for a company like Intel right now, it's not as though the money's not going to help and they're going to say no to it. Of course they're not, right? What Intel actually needs right now is sales. And both of these stakes, Martin Soong and also the U.S. government, is that going to get Intel anywhere closer to that goal?
That's a very good point, Martin. It doesn't get them the sales, but does it buy Intel some time? It's not just these two investors. Another famous investor and very successful one, David Tepper, has recently also taken a position in Intel. So it's quite intriguing. My own view on Intel is not anywhere near that positive, given where TSMC stands today or even where Samsung is going with its own investments and partnerships, whether it is with Apple or Tesla. But, if all these investors combine that with what government can actually move things around, what they want to do, can there be a turnaround at hand? I still find it difficult to believe.
Atul, wanted to get your read on SoftBank's overall AI and chip related investment strategy in the last sort of year or so. We know Masa-san, he goes big and he goes bold. He said that he was going to go all in on AI. We have seen that now in a lot of the announcements that have come out. How do you think he is positioned, and what are the biggest risks? Because you were talking about his AI strategy, you know, in the last decade. I mean, the analysts certainly would argue that one of his biggest positions is in OpenAI, and he got in there quite late.
You're right. He got in early on, I think, ARM. He got in early in a few other places. In fact, he was very early on NVIDIA in the beginning in 2019, a very tiny stake, which would have been, 100 times over ever since he divested. So he has been early on certain things. When it comes to OpenAI, you're spot on. It is not the first investment. This is the first investment was valued at $157 billion, and the recent one is being valued at $300 billion valuation. So it's not at all that it's in, SoftBank is investing in early stages of OpenAI's capital raising. It is late. The risk, if you are asking, is there are 4 or 5 major players trying to compete. One way to look at how this builds out is each of these players would end up having their own strong niche, their strong capabilities, and they'll monetize, and there'll be 3, 4, 5 winners. But if it is going to be just one winner, then it does matter who has the best capital raising capability and who's moving the fastest. So OpenAI was early, but it's again one of its toughest competitors. People say don't bet against that guy, and that happens to be Elon Musk with XAI and Grok. So, and there are other investors, other companies investing in the same space. Microsoft also is trying to balance its risks. It has early mover advantage for sure, but how it develops and where it goes, it's not a done deal just yet. So SoftBank is taking risk, of course.
Yeah. And whether you're bullish or not on Intel, there is definitely this sovereign put, and that's actually working in terms of the recent stock performance too for Intel. But what's the risk for SoftBank playing this role of a champion for onshoring chip manufacturing in the United States, sort of becoming a proxy for MAGA? Is there a risk for that?
I don't see it that way. It's basically a 1% equity ownership in that one. He's so far not talked about helping Intel build up capabilities or anything else. It's just equity stake at this point in time. If you're worried about the MAGA, you should have looked at day one of Trump announcement in term 1 as well as term 2. On both occasions, in the very first week, Masa was standing next to him. So if there was a risk on that side, then this one is not going to be any meaningful at all. And this is not exactly a risk. He's not deploying a very large amount of money. Thank you, guys. Have a nice day.
Just $2 billion US. Thank you so much, Atul, for your comments this morning. That was Atul Goyal from Jefferies Asia. And of course, our thanks to Lin for joining the conversation as well. Some earnings we're watching this morning. Xiaomi's second quarter revenue popping by about 30%, while its net profit more than doubled thanks to strong sales in consumer electronics products. Its sports utility vehicle, that's right, YU7, also generated strong orders for Xiaomi, exceeding market expectations. And Chinese EV maker Xpeng having its losses on record sales and robust margins. We'll see how those stocks will do when Hong Kong market opens in less than an hour from now. Marty?
All right, let's get to CNBC's Emily Chantan. Bit of context on those earnings. And Em, good morning. Great to see you. Chinese EV makers. I mean, it's cutthroat. It's like the Hunger Games, right? But the companies that Chery's was talking about, they are still managing to look pretty resilient.
Yeah, and this despite the government and their anti-involution campaign. We've seen overcapacity in this sector as well as price cuts, deep dives in some of those prices being sold, which was brought on by BYD earlier in the year. But both of these companies, as we've highlighted, both Xiaomi as well as XPeng seeing a very nice first half and second quarter numbers. As far as Xiaomi is concerned, we know that they started out as a smartphone maker, world's number 3 in fact, and the smartphone shipments in Southeast Asia rising very prominently, putting them number 1 in that market. They're number 2 in the EU and even comes with lower average selling prices. So we are looking at the numbers and the revenues coming through from segment, and it is the smartphones that is the biggest contributor here at $6.3 billion. Now, as far as EVs are concerned, they only entered the market in March of last year, and their newest model, the U7, has not even rolled off the showroom floor just yet. But they're staying away from the price war. Xiaomi saying that they're sticking to the strategy of making smart home appliances and EV home appliances benefiting from their seamless connection. They're also looking to enter Latin America in the third quarter of this year. So we are watching out for Xiaomi as well as XPeng. Both of these companies have outperformed in the stock market. Xiaomi shares pacing 52% year to date. XPeng also not too shabby in terms of the stock market gains that we have seen so far this year. Martin.
All right, good to know. Thank you, Emily Chantan, joining us from our studios up in Hong Kong. Still ahead, Australia's first ever orbital launch rocket, the Ares, failing on its debut launch, but the company behind the launch, Gilmore Space, is getting ready for the next attempt. Talk about that and the broader Australian aerospace industry with the company's CEO, Adam Gilmore. That is coming up straight ahead here on Squawk after this quick break. Welcome back. It's a midweek Wednesday here on Squawk Box Asia. Let's zoom in on Australia's space sector. Yes, it does have a space sector. Gilmore Space launching the country's first ever sovereign-made rocket last month. Its Eris rocket, well, didn't quite make it to orbit, crashing back to Earth shortly after liftoff. But Gilmore Space is still upbeat, confident it will succeed. Eventually, its CEO Adam Gilmore is in Singapore this week to court investors. He joins us around the desk here now at the SGX. And CNBC's Lin is also part of this conversation. Adam, great to see you again. Welcome back, and pleasure having you on the show. Got to ask you, that launch on the 30th from your spaceport, right?
Yeah.
What happened?
Oh, we lost an engine about 2 seconds into the flight, and then the guidance navigation and control system worked beautifully because it's not supposed to work with one of the 4 engines out, and then we kept going up because we had a lot of thruster weight, and then we lost another engine about 8 seconds into the flight, and then we couldn't keep going up anymore, so we came back down. But the rocket was up there for 18 months while we waited for space agency approval, so we kind of called it the old cranky rocket. So we were really happy that it got off the pad.
Yeah.
We'd managed expectations well with our investors, and when I'm talking to investors in Australia and up here,
You're at Series E, right?
yeah, we're doing Series E.
Okay.
And I've mentioned that nobody gets to orbit on the first attempt, and our flight time was right in the middle, just behind SpaceX's first launch attempt. So I'm feeling pretty good.
All right, you're in good company then, sounds like. But look, sounds as though that launch that failed on the 30th from your spaceport was an engine problem, right? I know your engines are hybrid, right? Liquid as well as solid, is that right?
Yeah, that's right, yeah. So that's why you didn't see a massive explosion, because there's 2 different phases of matter. Yeah. And so you can come down quite gently, and we didn't damage any of the launch site, any of our test facility, and that makes me happy as well.
Okay.
And I guess going forward now, Adam, how many more attempts are you factoring in, and when do you expect success here?
Well, we're going to try very hard to get it on the next attempt, but the average of all of the rocket companies that have done it before us is 3. So we're telling investors that we want to bank on the 3rd launch attempt being successful and then enter the commercial market after that.
And you're in Singapore at the moment to raise more funds here, right? A Series E, as we were just saying. What is the investor pitch now post this attempt? 14 seconds in the air.
Well, the pitch is it takes forever to get to the first launch, the first orbital launch. And once you've done that, you can go fast after that. And so the average after that is another 8 months later, and then another 6 to 8 months later. And then after that, your valuation goes up 4 times and you're in the commercial side. So I'm telling investors we're at the cusp of commercialization, and with this round we're going to move into commercialization and then be worth a lot of money 2 or 3 years in the future.
How do you, I'm very curious about, the Australian space sector. I'm just wondering, how do you characterise how it's going at the moment, and why are there so few success stories like yours, given that the geography in Australia lends itself, right, to startups like yours?
It's a really, really good question. I think that government's been a little bit slow to kind of step in, and they're aware of what we're doing now. Deputy Prime Minister's visited us. They're giving us a lot of verbal love now, and I'm confident that we'll get more activity out of the government. But most of our money is from venture capital. We have had some government investment as well, and there's government interest in this round as well. So I think they kind of wait. Australia waits for you to do some success and then backs you, and we're kind of there now.
Adam, talk to us about size and also payload weight, et cetera, right? You're orbital, I know that. The total addressable market, TAD, civil, commercial, defense, et cetera, how big is that? How competitive is it?
Oh, it's massive. I mean, if I just give you an example, Amazon's putting 4,200 satellites up. They have a 5-year lifespan. They decay through time, and they're in 36 different orbital planes. So you can do the maths. It's roughly 500, 600 a year will decay all over the place. And so they need a small rocket launcher like ours to take the 2s and 3s back. And that's what we're very excited about. So in essence, you're saying that demand outstrips supply right now. So, in terms of your competitive advantage at Gilmore Space, what would it be? Well, competitive advantage is we're low cost. Our rocket engine technology is way cheaper than some of the other competitors we have. Our labour costs are low compared to the US market. And we've got our own launch site, so we don't have to worry about sitting in a queue behind anybody else. And so we've just kept the costs down all in every place we can. And we've just got to get cadence. We've got to get launching, many rockets, and that's my challenge. Is I've got to build a lot of rockets.
Okay.
In the geopolitical context that we're in at the moment, there's so much talk, whether it's Japan, whether it's the US, China, about self-sufficiency, self-reliance. Now, Australia depends heavily on foreign satellites and data sharing, and certainly that's why we have alliances, right? But is Australia not being ambitious enough when it comes to these sorts of things to, I guess, prepare for the future?
It hasn't been in the past, but it is now. And so I'm flying back to Australia and I'm going to a defence meeting on Friday, and that'll be talking about a satellite constellation that they want to deploy. I can't talk much about it, obviously, but we're going to step up to the plate now as a nation, and you will see that the government will be putting satellites in space really soon.
So here's a question for you, Adam. Elon Musk and SpaceX, one of the reasons that they literally turned the space world upside down was reusable rockets, right? And, famous vids, this giant rocket being caught by what looks like a pair of giant mechanical chopsticks, right? Is that something that is something you're exploring, or at your end of the market for your size and your payload, et cetera? Is it not economical?
It's not economic for the size of the vehicle we're in now, but we are intending to go into a slightly bigger vehicle. And I think reusability is an inevitable path that you must tread as a rocket company. We've got friends at SpaceX, and they've told us, don't do it until you're regularly launching to space, because the R&D cost is huge. And you don't want to burn all your capital now. I need to spend it to just get my rockets working first. We've got plenty of margin in the rocket. We can make good money out of a non-reusable rocket, but I think it's inevitable as a rocket company, you have to have a reusable rocket.
All right, Adam, listen, been fascinating talking to you. Thank you so much for your time. Great to see you again. Good luck fundraising, and come back see us again very soon.
Thank you very much.
Pleasure is ours. All right, to Adam Gilmore there from Gilmore Space, and Lin Lin part of the conversation as well. All right, let's get back to markets and show you how we're shaping up so far this Wednesday morning, midweek, out here in Asia. Lead from Wall Street, not good. And, it's playing through pretty much the same way. A lot of negative follow through. Tokyo is down close to 1.5%. The Korean market is almost there. Sydney is down fractionally, just below the line as well. Stay tuned. The rest of the market opens coming up top of the next hour. Taiwan, Singapore, and Malaysia join trade. Opening numbers when we come right back in 2. 0.05 of 1%. And you're looking at pictures of a gong show going on. And you might be wondering what's happening. Well, we've got two new bonds hitting the market this morning at the SGX. One is a Singapore dollar denominated bond. The other, a Chinese renminbi denominated bond. Both of them issued by ICBC, and both are green bonds. The money raised is going to be used for financing sustainability projects. So that's what all the confetti is about this morning. I'm Martin Soong here at the SGX watching it.
We love gong shows and confettis. I'm Chery Kang in Hong Kong. Let's get to your headlines this hour. Asian markets struggling this morning following the weak lead from Wall Street. South Korea's Kospi, the underperformer this morning as investors are de-risking out of big tech and AI and cryptos.
Japan SoftBank Group, one of the biggest losers this morning up in Tokyo. The company has big tech investments under its Vision Fund. The stock slumping 8% so far this morning on the back of the U.S. AI and tech sell-off overnight.
Plus, the Chinese EV players Xpeng and Xiaomi posting better than expected quarterly results despite cutthroat competition in the country's auto sector. We'll check reaction in their Hong Kong listed stocks just ahead.
Get right to markets. Some of the smaller secondary markets just coming online for midweek trade. Singapore, Malaysia, and Taiwan among them. There you go. Singapore, just to recap, opening up to the weak side, as is Kuala Lumpur and Taiwan as well. Losses there a bit sharper, down to about 1% and more there. Let's flip the charts and give you a look at the big fellas, the big markets. An hour plus into Wednesday trade. Also not looking good. Nikkei 225, Tokyo, in other words, is down 1.25%. The Kospi in Seoul is down by roughly the same quantum. The only market in the money so far this morning seems to be Sydney, but just fractionally above the line there. Getting back to Tokyo, though, I want to take a look at shares of SoftBank Group and show you those. We're at 14,885 and change on SoftBank Group. The stock is now down 7.25% or thereabouts, so it is off session lows. But it is under pressure after news yesterday that it is investing $2 billion into the storied but still struggling U.S. chip maker Intel. And this is at the same time as the Trump administration is considering taking a 10% equity stake in Intel as well through a swap for CHIPS money grants. Also on Earnings Watch, take a look at shares of Xiaomi, Xpeng, and also PopMart. At the pre-open. This is ahead of 9:30 when China and Hong Kong markets come online. Xiaomi revenue popping 30% second quarter despite a slowdown in its smartphone sales and also an EV price war domestically. And rival Xpeng, meantime, bullish on EV demand, forecasting its revenues are going to double this quarter. And let's get to PopMart as well. The name behind those ugly, cute Labubu dolls, posting a near 400% surge in first half net profits. Our colleague Emily Chantan is going to be diving deeper into this story a little later on this hour. Chery?
Yeah, Marcella Chow is a global market strategist at JP Morgan Asset Management. Do you have one of those on your bag, Labubu?
No, I'm a fan of Jellycat.
Yes. Do you see a trend there when it comes to China? Because we had this whole chat the other day with a guest, and when it comes to China markets, it's really the interesting new trends are picking up, and I just wanted to, pick your brain about that.
Indeed, we actually recently wrote a paper on this, and that with China market recently performing quite well, it's actually triggered and supported by the X share with all these thematics. It's not just about the Labubus, and it's also, for example, the earlier on the DeepSeek, and also, for example, with the Naja, like the entertainment industry, and also recently the biotech. So all these new themes are available and abundant in the X-share market. And while Asia is more about the high yield, the defensive, and recently it's been supported by like all the retail flows. So we are suggesting with, for example, in US, we do acknowledge how the AI everything story continues, but then with broadening out with how we need to diversify across various regions, China remains a key focus, and that we can actually do a barbell strategy with both X-share, with all these new themes, thematics, because of a change in lifestyle of Gen Z, the instant gratification, how they actually seek happiness from like all these toys and all these other experiences. We actually have a word T for it. T for like E is for experience, A is for technological innovation, A is for affordable luxuries. So all these like TEA is the new themes that we are actually constructive on in the near to medium term. And so X-share and then A-share is for the defensiveness and the resilience with all these ongoing volatilities in the market.
So sort of the H shares are sort of the sexy new economy ideas.
Indeed.
Is there something that you're watching that's sort of brewing, but people are not really paying attention or not talking enough about in terms of those new trends that you're watching?
Indeed, like with the AI everything story, we see actually people always focus on US, but we see the emerging trends within Taiwan and Korea. Earlier on with more with soft tech, with DeepSeek, and then it's back to hard tech, and that we see investment back into hard tech like Taiwan, Korea. That's why I've been year to date outperformers. And going on is both soft tech and hard tech, suggesting that the focus can be back into not just US tech, but also into Asia tech.
So when you say tech in Taiwan and South Korea, it's mostly hardware though,
Yeah, the
right?
hardware for Taiwan and Korea and Japan, and for soft tech is China and Hong Kong.
Exactly.
Yeah.
So when it comes to those hard tech ideas, I mean, Taiwan, South Korea had a good run, and South Korea is being sort of tested right now. But you said that AI trades are staying intact for now. So
Indeed.
what we saw just overnight and what we're seeing in Asia this morning is just a buy the dip kind of moment.
Indeed, and there should still be upside potential given the earnings that we see from the big mega cap in US, and also within Asia, the earnings remain quite supportive, especially for the hardware technology companies within Korea and Taiwan.
Marty?
Hey, Marcella, good morning. Great to see you and a pleasure having you on the show. Look, I don't want to get you into trouble with your compliance folks, right? But we've been talking a lot about SoftBank and its $2 billion investment into Intel, INTC. If nothing else, can you just give us your maybe your personal take or sense on what's going on there? Because, Masayoshi Son is betting big on AI, continuing to do so, but he does have a track record of being late to the party quite often.
Personally, with like our individual company, we are not in the right position to comment. But then we do see, for example, in both Korea and Taiwan, and also like Japan is also a key supporter of, for example, of hard tech, and also recently into soft tech. But then, for example, Korea and Taiwan, we are more prone to. Recently, we see the worries about, for example, export front loading, etc., that may actually diminish. But then we continue to see, for example, technological advancement that will support not just Japan, but also Korea and Taiwan going forward in the near term.
All right, that's good to know. Listen, we've spent a fair bit of time talking about equities. Talk to us about fixed income. You're taking a barbell approach here. Tell us what you like, tell us what you don't.
Indeed, in the near term, we do think gradually as the rate cut expectations continue to build, we highlight how investors can start extending durations. But in the near term, we see that spreads remain quite tight for example, IG, with a legit reason, because, for example, the rate cut expectation, the fundamentals remain quite strong. And so quality remains key. And so for the near term, for example, a barbell within the IG to build resilience, and for those seeking for yield can go for high yield, because so far the default rate still remains relatively low.
All right. On the one end, govies. On the other end, corporate high yield. Got to ask you, the term premium, are you getting compensated enough for high yield right now? Because, we've been talking to a number of guests on the show, and we note that overall, generally, right, credits, corporate bonds, right, their spreads, it's like, where is the spread? There is no spread.
Indeed, like for the fundamental side of things, we do see high yield remains quite supportive. But yes, indeed the spreads may not be that attractive right now. But then that's why we actually try to seek income from various sources, not just from fixed income, but also from the equity income. And we have actually recently been highlighting strategy like option overlay, etc., where you can actually embrace the volatility and that you can turn into more income with the option overlay strategy. And also, for example, with alternatives, given how inflation might remain sticky and stickier than expected, this might be various ways that investors can seek extra income in this uncertain environment.
So staying with that alternative idea, what do you like? Because obviously there is this major rethink of traditional looking portfolios. 60-40 is sort of out the window. That's not really working. It's not just boring, it's not working. So what do you like in that space? Because I heard, private, some are talking about gold, and then even like throw in some Chinese yuan in there. Is that what you're going for?
We're more into, for example, for infrastructure lately, because yes, we have
real assets,
like real assets infrastructure, especially given the ongoing supply chain disruptions. This is actually may be hurting consumers, but it's actually benefiting those, for example, infrastructure with, for example, transport, etc. So transportation and infrastructure are the ones that we continue to be quite constructive.
When you say infrastructure, I'm only thinking about data center. Am I wrong to do that?
There are various, and there are data centers.
in 2025,
yeah,
what's
especially
sexy?
Given like the hype recently, data center. But there are also other infrastructure that remains quite supportive. And from transport-wise, we see that with the supply chain, the shipping, and also the energy. Yes, there have been various arguments about energy sufficiency and energy self-reliance, but then there are actually different various sources of energy. So even though no matter it's clean energy or the traditional ones, we do have a bias on, and we have investments and contracts on those. And so no matter where the wind blows, we do have various supportive factors for those.
When it comes to China, because you say you still favor the China market, what is a good exposure to get into now, and how to get that exposure in terms of which asset class that you prefer in 2025?
For China, probably like the A share, for those that are more risk averse in the near term, given how China A shares have been relatively uncorrelated to all the global uncertainties, and in previous few months, when the market was quite volatile, A share has been relatively resilient in a way. And then A share probably for more the high dividend and sectors like financials, etc. And meanwhile, for X share is for the sexy themes that we talked about. And A share, we see that retail flows have been relatively quite strong. And in history, we see that this exuberance can last a bit longer than expected. For example, in 2014 to 2015, we see that it lasts for around 12 months. For X share, probably 2 to 3 months or so. But recently, the margin financing volume as a percentage market cap remains quite low. And also, for example, there have been an increase in number of percentage of deposits, and those can get transferred or translated into deposits, into the equity market if performance or sentiment keeps on improving.
How meaningful is this whole anti-involution campaign? Do you think it will have the same effect of the 2016 campaign? And that's a good thing, right, for the equities markets?
Indeed, in 2016, we see that it managed to boost economic growth and corporate profitability. Right now, given the current macro situation, it's still a wait and see, and need to see, for example, the recent interest subsidy scheme, the 1% loan subsidy, will that have an impact? And that might actually, because it's implementing, for example, in September, the impact might suggest that the August retail sales might remain weak. So there have been a lot of observation and wait and see mode. And for the anti-involution campaign, we see that the goal is to, for example, like you said, cracking disorderly price competition, alleviate the deflation impact. But indeed, we still need to see the exact impact given the current macro situation. And also, we see right now they are more on the supply side reform and diverting away from the counter-cyclical growth stabilization effort. But we will also be more data dependent. We believe once data starts to weaken significantly, they might turn back into more providing more monetary and fiscal stimulus.
Well, because deflation is pretty much like across the board in China. And correct me if I'm wrong. If this whole anti-involution campaign, even if it works, it's just about really just tinkering around with certain sectors. So it's not going to really change that deflationary narrative.
And the key is to improve the consumer confidence, which remains quite weak, and also the job insecurity that a lot of the population and with the demographic challenges, etc. But we do see the Chinese government has been diverting or trying to divert the credit resources into, for example, high-tech manufacturing and also into enhancing the new productivity forces. So whether this balance will work is still a question that let's wait and see and assess the progress afterwards.
So we started the interview with consumers. So let's go back there. Consumers in China, and I love how you politely put it as an instant gratification instead of YOLO, because I would have gone with the YOLO. Is that what's happening, that they're not really feeling confident still, and then they're sort of parking their money into outside of China if they can afford to do that, if they find a way to do it? Or is the stock markets and this sort of stealth bull run giving them some comfort at the moment?
Indeed, like the A-share market, we see that investors, the retail investors, recently with the trading volume up 80% year on year, suggests that they are starting to get a bit more optimistic about the market and also the performance. But yes, indeed, the fundamentals is deviating from the actual market performance. So it's wait to see whether the fundamentals, because we see earnings estimate actually keep revising downwards. So we need to see that to improve before we see a broader improvement in the market performance. But the exuberance can last for a bit, but we do need supportive factors. And also on your point about the younger generation, with the university students, we do see the sentiment remains still actually subdued because the ones that are the popular or the sexy hype on jobs are the ones that they are not able to find in universities. So the mismatch suggests that there also needs to be education reform that might need to last for a few or 5 to 10 years before it's impactful and supportive to the market.
I see. So looking for real changes and perhaps real money as well. Marcella, it's great to have you on. Thank you so much for coming in this morning. That was Marcella Chow from JP Morgan Asset Management. Squawk is coming right back after this.
Welcome back. It's a midweek Wednesday here on Squawk Asia. Take a look. U.S. tech stocks are pulling back pretty sharply across the board overnight, except for one green spot, and that is top left corner of our beautiful wall there, INTC, the storied but still struggling U.S. chip giant. This comes after it received a $2 billion lifeline from Japan's SoftBank Group. Lin is on that story. Good morning.
Yeah, indeed, and it launches and will launch SoftBank to become one of the top 10 shareholders of Intel as well, together with this potential of U.S. investment into the company. Certainly, we are seeing this vote of confidence in Intel, which has been struggling for many years now. But the question is it enough, given that what they really need is sales? They need major customers, and on that front, it doesn't seem like any of these announcements or potential announcements will be forthcoming on that front. There is reports to suggest that in terms of the SoftBank investment, it is just the $2 billion. There is no other element in terms of purchasing any of Intel's products. And we heard from Scott Bessent as well earlier today, where he said, you know, any kind of investment we would make is to stabilize the company. We're not going to be helping the company find customers as well. In terms of what is behind the move for SoftBank as well, we spoke with Atul Goyal, who is a senior analyst at Jefferies Asia, to get his take. He believes this is a part of, I suppose, building that relationship with the US president. Let's watch.
What he's doing with Intel, he seems to be partnering the US government, it seems. From what I see, it's very difficult for Intel to claw back its previous glory. And it's very difficult for them to compete, whether it's foundry side of the business with TSMC or even on design. So it's got a very difficult task ahead. And what SoftBank has done is, with $2 billion, it's less than 2% stake in Intel, with less than, maybe about 1% of their own market cap. So it's not a very big investment for SoftBank and for Masa.
And this investment announcement comes as there has been a report as well that says that Intel and SoftBank, they were talking a couple of weeks before the announcement was made, with the potential there in terms of discussion around buying Intel's foundry business effectively. And of course, this has not eventuated, but this investment does not preclude any kind of potential bigger deal. So certainly a watch point ahead. Chery.
Yeah, thank you very much, Lynn, for that. The SoftBank Group shares are down 8.5%. In the meantime, CNBC's The China Connection comes on at the top of the next hour. Our Emily Tan is here with a sneak peek at on some of the stories that she's watching. And I don't know, Pop Mart might pop.
Well, it is popping, and I think the shares, of course, reacting nicely, Chery, to the latest report card that came out, beating the company's own estimates on the top and bottom line when it had called for profits to jump 350% and revenues to top 200%. It outdid itself. So first half profit up almost 400% to $626 million on revenues of $1.2 billion. It is seeing high demand for its toys. It has a lot of different IPs. Of course, we always talk about Labubu. That's under the Monsters collection, but there are a number of other IPs that Pop Mart has as well. And I do want to point out one metric here. Sales of Labubu to surpass 10 million units per day from September of this year. That is outstanding. Now, as I also mentioned, the Monsters raking in something like $669 million in the first half of this year, and that accounted for about 35% of the company's revenues. So revenues from external customers in China, 1.1 billion, overseas operations at 778 million. The company operates 571 stores across 18 different countries, and just in the first half, they added 40 new stores. And they also have something called robo shops, which are automated shops. So kind of like those machines where you can grab your own toys. I think that's what that is. 2,597 robo shops, and they increased 100 shops in the reporting period. So we are seeing a lot of demand for Pop Mart IP for their toys. A little bit of give back today. Pop Mart shares were at record highs, and of course, profit taking after the stock has gained over 100% year to date. So we're going to be watching out for that. Lots of things coming up on the China Connection. We'll be talking to Theodore Shou from Yi Capital about the Chinese markets, which have been trading at a 10-year high. Also, S&P Global Ratings as China looks to Global South. Charles Chang from S&P Global Ratings will join us. And then all about the earnings, we have been discussing Xiaomi this morning, and Sean Yang from Arete Research. He'll be on board to talk about the latest coming through from Xiaomi.
All right, amazing lineup. Thank you so much, Emily, for that. Coming up on the show, we've got Hong Kong and mainland China markets coming online in just a few minutes. The futures are looking softer. We'll bring you the opening trades when Squawk comes right back. Good morning. You are watching Squawk Box Asia. Markets in Hong Kong and China just coming online. Along with the view of Hong Kong Island, let's take a look at the Hang Seng Index this morning. We've got the index down 0.7% and right below that to 25,000 level. So we'll see what kind of session today holds. Taking a look at some of the top heavyweights, and of course, today is the day that we see a lot of AI proxies getting tested, and we see that sort of follow through in Hong Kong markets as well. A lot of technology names getting punished. Alibaba down more than 1%. Xiaomi down as much as, well, close to 2% this morning. Zooming in on Xiaomi, by the way, bottom of the board there, our colleague Emily Tan was just talking about this. The smartphone maker, which is also involved in EV business, posted a 30% jump in revenue just last quarter, and the shares are down 2%. And its rival, Xpeng, bullish on EV demand, forecasting its revenue to double this quarter. And take a look at the divergence in this space. We've got Xpeng sitting higher by 3.5%. And PopMart, the earnings report that we were all waiting for, with a lot of anticipation yesterday. PopMart, maker of the popular Labubu doll, posting a near 400% surge in first half net profit. Revenue also jumped triple digits on the year. No guesses why, as the company saw high demand for its toys domestically and overseas. Shares, though, down 2.5%. It did have a good run. I mean, come on, 200% year to date. So we've got that stock sort of facing some profit taking. And in the meantime, let's take a look at the mainland markets this morning, opening up at the same time. And we've got... Let's show our viewers what kind of price action we've got here. So yes, down is what we saw in the futures, and we see that in cash trade. Chinext is really the laggard here, obviously being China's sort of a NASDAQ-style board there. Chinext down close to 2%, and the Chinese yuan is doing this. So 7.1871 per dollar is what we see there. So the dollar is actually strengthening versus the CNY. The PBOC's midpoint fixing this morning coming in at 713.84. So that is up, but much less than what the market was primed for. So I think that is one function of that. And we also got 1-year and 5-year loan prime rates out. Top of the hour, unchanged as widely expected. So that's not really moving any needle there. In the meantime, ties between economic powerhouses. Yes, we're talking about China and India. They're in focus. I mean, as Chinese Foreign Minister Wang Yi wraps up his state visit to New Delhi, our China correspondent Elaine Yu has more. And, China's perspective in all this. So what is it? Because we had a guest on earlier in the show talking about how China and India, they've been working to improve this relationship for some time now, even before the Trump administration's, 2.0.
Right, and this is definitely a step in the thawing China-India ties, as it is Wang Yi's first visit to India in 3 years, and it lays a stronger groundwork for when Modi visits Tianjin in China for the Shanghai Cooperation Organization Summit as well. But according to China's readout, China attaches great importance, it says, to Modi's attendance at the SCO summit, and Modi has written on X that he's looking forward to meeting President Xi at the summit too. The backdrop to all this is, of course, India's deteriorating ties with the U.S., which Beijing would welcome. But we've also seen Chinese commentaries suggesting that India improving ties with China is partly forced, given the volatility in U.S.-India ties. But nonetheless, the two sides agreed to resume direct flights to facilitate trade and investment flows and to manage and de-escalate border tensions. And also when the Foreign Ministry was asked about reports that China is lifting rare earth exports to India, the spokesperson of the Foreign Ministry says they're not aware of that, but they're willing to work and strengthen dialogue with countries on that, Marty.
Wow, would be very interesting if that were to happen, right? China rare earths to India. But Elaine, from what we understand, the official agenda Wang Yi and Modi, they're going to be talking about border issues, and they have a long history of that, right? It's very emotive and very tense, but that's just the beginning. There's got to be a lot more.
Yeah, and the border issue has been the main flashpoint in the bilateral ties. But now Wang Yi does say that the setbacks we experienced in the past few years were not in the interest of the people of both countries. And he also said we are heartened to see the stability that is now restored in the border. So very positive rhetoric coming out of Beijing. So the two sides did reach consensus on the border issue, according to China's readout, including setting up a working group to help manage the border and keep things peaceful, and to use diplomatic and military channels to agree on how to de-escalate tensions. And they also talked about renewing a flood reporting agreement where China will share emergency river data with India for humanitarian reasons. And if you recall China's new mega dam that began construction in Tibet recently, that made India very nervous about any potential sudden water releases that could disrupt or displace livelihoods of people downstream. That would be something that India would be watching very closely and would welcome as well, with the river also being a border issue now. And now Wang Yi is headed to Pakistan next. And given that tensions between India and Pakistan has escalated recently, India no doubt will watch very closely how China handles its relationship with both India and Pakistan, Marty.
Indeed, it's going to be a very delicate juggling act. Thank you, Elaine, you there reporting. All right, looking ahead, Indian Prime Minister Narendra Modi, meantime, hailing strong and steady ties with China. And this is ahead of his trip to China at the end of the month, when he'll be meeting with Chinese President Xi Jinping. Inside India, anchor Sri Jagaraja watching this very closely, especially as India's relations with the U.S. are probably at the lowest they've been in 30 years.
That's exactly right, Martin. Let me just add to what Elaine laid out there. And the catalyst for this apparent thaw in India-China relations is this deteriorating relationship with the United States. So the prospects of a trade deal, they are fading fast. We now know that the US delegation that was expected to be in country in India on August the 25th to engage in the 6th round of negotiations, that is off. That is cancelled. They are not coming. And if that wasn't enough, August the 27th looms, and that is when additional US tariffs, an additional 25%, are going to be imposed. And judging from Peter Navarro's comments in Monday's op-ed in the Financial Times, it looks like the US is doubling down on that position. And it looks like there is a non-trivial risk that India is going to be faced with 50% tariffs from the US. All of this is driving India to intensify its realignment, intensify its diversification, strategic diversification of trade partners. And the way that this is happening most visibly is within the BRICS. And of course, let's single out the C in the BRICS, and that is China. Wang Yi was absolutely clear, wasn't he, about Beijing's position under the current international situation. Strategic value of China-India cooperation is more prominent. But as Elaine said, this is not going to be easy. This is going to be incredibly challenging to move forward in terms of forming closer ties. She was talking about long-standing border concerns. That is going to be on the agenda. That was seriously inflamed, Martin, with the recent conflict during Operation Sindoor and the high-profile downing of Indian Air Force jets by Chinese-made PAF fighter jets. So that really struck a nerve in India, and it's a clear reminder of the geopolitical sensitivity of the region and China's influence in Pakistan. However, there is something big. There is a lot that could emerge from closer ties. Michael Coogan was on your programme earlier, and he was talking about the prospects of rare earth minerals and how that could be a catalyst. This is what he had to say.
That would be a big deal if that rare earth issue was worked out. That would be a big boost for India-China relations at a moment when that relationship is already enjoying a lot of momentum. But that said, I don't think we should go too far. I mean, India and China remain strategic competitors. They've got a long disputed border that's been the site of many clashes. There's a lot of distrust baked into the relationship for that reason. And China continues to have a deep alliance with Pakistan, India's arch rival. So I think it'll be difficult to get around those issues, even if we see improvements in the relationship in other areas.
I don't think there's going to be any breakthrough that comes as a result of this. No immediate alleviation of long-standing border issues and the tensions there. But having said all that, Martin, despite all this strategic rivalry, it's fascinating to see that Indian consumers are buying Chinese products, ostensibly mobile phones. Vivo, Oppo, Xiaomi are among the top-selling phones in India because they've been restricted by tariffs from the US market. Yesterday, I had a fascinating conversation on Inside India with Saurabh Mukherjee, and he and I were talking about the prospects of deal-making that may arise from closer India-China ties. He said if it did produce a breakthrough, that could pave the way for major Chinese investment in India from the likes of BYD. This is what he said.
My reading is the Prime Minister's trip to China might presage, the Indian Prime Minister's trip to China might presage a larger play by BYD in India. And if that's the case, if BYD is coming to India, but potentially in a JV with a powerful Indian firm, if BYD is coming to India, then I think the Indian automakers will have a far greater competitive challenge than they have probably encountered ever in their lives.
So, Martin, I'll say this about Prime Minister Modi. He is a masterful diplomat. He is a masterful diversifier of the trade picture and trade partners. We've got a UK, well, India has a UK deal, is working on an EU deal as well. But it's clear that India and China see the mutual compatibility of playing the long game here. That being said, India's relations with US are the worst in decades, but perhaps not beyond repair. And next month, Modi will be in the United States for the UNGA, the UN General Assembly. So maybe that may provide an opportunity for Modi and Trump to sit down together and thrash out these issues and pull the relationship from the brink. But right now, the optics do not look good at all. Hence, India continues to hedge its bets.
Okay, you're going to be continuing to talk about this whole situation on your show, Inside India, coming up. You've got a lot of big guests today.
We will indeed. We'll continue the conversation on technology and AI and ChatGPT, which is launching, ChatGPT Go, which is launching in India. We'll do that with Neil Shah from Counterpoint Research, and then we'll talk about how the Indian equity markets are handling the balance of risks on the external front and on the domestic front as well. And let's face it, we haven't seen an altogether blockbuster earnings season from the Indian corporates. So that's played a role in hitting market sentiment in India. But let's see what happens in terms of closer alignment between India and China. And maybe that may provide something of a fillip to the markets and confidence.
Okay, excellent stuff as always. Thank you, Sri Jagaraja there. Looking forward to Inside India a little later on this morning right here on CNBC. Meantime, coming up on Squawk, we'll shift gears to a key emerging market, which is Indonesia. Our next guest is urging investors to watch out for consumer, telco, and healthcare names as that country ramps up efforts to try and boost its economy. Ari Yahya from Macquarie Capital joins us, along with CNBC's JP Ong, when we come right back after this.
Welcome back. Let's zoom in on Indonesia in this segment. The Jakarta Composite up about 11% so far this year. JP Yong is joining us, and certainly feels like the 8,000 mark is going to be the key test for this index, right, JP?
Yeah, absolutely, Sherry. And again, it seems that the Jakarta Composite in the last couple of weeks has actually found a new ceiling or resistance level, actually, after it briefly touched 8,000, which was preceded by 2 straight days of a decline. But that 2-day losing streak for the Jakarta Composite is not a cause to worry, actually, because it seems that the Jakarta Composite has found new room to rise after it breached that 7,300 level earlier this year. It seems that this all on the back of a second half resurgence or renaissance for Indonesian stocks that were pummeled very brutally, actually, in the first half of this year. As you noted, they are one of the 3 best performing indices now in Southeast Asia, and a lot of this really coming over the last 2 months on the back of a renewed optimism with regards to the economy, also a renewed optimism with regards to certain big movers in the renewable energy space there, and also perhaps some certainty after it was finalized that the reciprocal tariff will remain at about 19%. Now, it's also important to note, Sherry, that the economic recovery in Indonesia seems to be back on track, or there is renewed confidence at the moment. But the recent rally was also underpinned by a handful of stocks that actually saw free floats of less than 10%. So there are questions as to how sustainable the rally itself can be. But there is also more room to be optimistic. In fact, that is on the back of the possibility that we might see more rate cuts down the road. Now, the Bank of Indonesia is set to make their policy decision later on today. And while economists surveyed by Reuters expecting that the rate, that is the policy rate, will stay unchanged at 5.25%, they might wait until the fourth quarter because they want to see more stability with the rupiah, behind the Indonesian rupiah, and also possibly more rate cuts first from the Federal Reserve before they loosen policy themselves. Take a look at that, Sherry. 5.25% is where it sits right now, which means they have a lot of room to ease policy once these conditions start to improve. And when that happens, more liquidity and more support for equities might be on the way in Jakarta, which means that there could be another leg or another booster, that is, for Indonesian stocks down the road. But again, they'll have to get some of these other things in place. Once that happens, we might see more upside, that is, for Indonesian equities down the line.
Yeah, stay with us and let's continue the conversation with Ari Yahya. He is head of research Indonesia at Macquarie Capital. He's in town for Macquarie's 16th ASEAN conference. Ari, it's great to have you on. So not just Indonesia alone, but I was hearing that there have been over 60 rate cuts globally in 2025 alone. And for Indonesia, you see extra juice potentially coming from this larger than expected budget deficit. Walk us through your thinking here.
Yeah, sure. Thanks for having me today. So first, on the rate cuts, I think there's still room for several rate cuts to come in the next year or so, and even in the coming months, on the back of the need for Indonesia to boost growth. So we need additional stimulus there. And then on top of that, the rupiah has been actually quite stable, hovering close to 16,300, and then inflation has been manageable in the low single-digit territory. So these will be the criteria that I think should be sufficient for BI to cut rates. And then moving to the fiscal side, yes, that this year's fiscal will be around 2.8% of GDP, but on the back of the 2026 draft budget just got announced on Friday, we see the government is targeting a narrower deficit next year on a year-on-year basis to 2.5% of GDP. Although I think in terms of the assumptions, the revenue outlook looks bullish. But then if you were to basically assume a slower revenue growth, we're still going to see the budget deficit closer to 3%. So what's important is that if you look at the spending areas that could help to stimulate growth, that includes spending for social aid, healthcare, education, and of course the government's priority programs, including the free meals, which is projected to jump about 4.7x year on year. So this could help to actually boost our GDP growth further. They are assuming 5.4% GDP for next year.
All right, there's a lot to actually delve into with regards to Indonesia, but I want to start off with the Bank Indonesia because many economists surveyed by Reuters and Refinitiv say that the cut will probably happen in the fourth quarter. As you mentioned, there's a lot of room actually. What do you think is the Bank of Indonesia waiting for before they actually embark on these rate cuts that seems to be more of a matter of when rather than if?
Yeah, good question, JP. So I think, they want to see basically the stabilization in the rupiah, which I think has been. Mm-hmm. And also if you look at on top of that, the other factors, including the 10-year bond yield, the demand has been strong. We actually see the yield dipping from close to 7% at the beginning of the year to 6.4%. And then inflation actually is still hovering low single digit. So I think, yeah, they should be able to cut sooner than later, in my view.
And since you mentioned the budget a while ago, a lot has been made of this actually, because what we've seen in the Prabowo administration now is a pivot from hard infrastructure towards developing human capital, the school lunches, for instance, the education thrust from them. These things take time, though, before they actually show up and perhaps provide a booster to Southeast Asia's largest economy. Do you think that it's too early perhaps to price in the upside of these things, given the fact that they're only starting to make this pivot now?
Yeah, sure, JP. So I think in terms of the execution, that's what's key. Because if you look at the ramp up of certain priority programs, it's still quite slow in the first half of the year. But there are indeed signs of government spending starting to pick up in the past couple of months. So I think that's going to be one of the factors that drive our GDP growth improving further in the second half. So what's interesting, as we talk to the corporates that attend the Macquarie ASEAN conference in the past couple of days, they do see that the July figures actually is already showing some month-on-month improvement, although it's still a bit sluggish year on year. So hopefully this momentum can continue through the remainder of the year.
So are these same corporates saying that this could actually lead to an improvement in earnings, for instance? And how soon do you think that might show up? Because that also is something that investors are perhaps asking themselves as they wonder if this rally indeed has legs or has another step up in itself.
Yeah, sure. So essentially, if you look at the what I'm referring to, the government spending is overall spending. It's not just relates to one program or two. But in general, the pace of the spending has improved. So we do expect that if that momentum persists, then I think earnings recovery could start to be seen on a quarter-on-quarter basis, starting as early as third quarter of a low base. Because after the second quarter results, we already see basically consensus cuts on earnings expectations. So baseline is a bit low, which is good. So provides a good backdrop for potential recovery on multiples. But obviously for 2026, the government also already assuming that the realization of spending will be faster. And also the SOE capex realization also will be faster after the SOE is getting transitioned to under the Danantaro's leadership.
Okay, some of the skeptics who are looking at this rally raise the point, and perhaps a salient point also, that the rally is really being driven by a lot of these large cap stocks with very small free floats, the likes of Barito Renewables, Chandra Asri, for instance, come to mind. Now, I won't ask you to really delve into these stocks specifically, but if you take this off and the possibility of them getting listed on the MSCI indices, what else is there that leads you to believe that the rally in Indonesia can indeed be sustained? And are there other levers that are showing that are supporting this rally apart from these two outsized moves from these low free float stocks?
Sure, yeah. Indonesia, as a matter of fact, is one of the countries receiving the net inflow that are the highest upon the MSCI August review. But even if you extrapolate other sectors, right, or other names beyond those low free float names, I think there are opportunities for large cap laggards to basically rally further. If you look at the valuations compared to historical average, still remain to be reasonable. Expectations remain to be quite low. And of course, there are a number of stocks that we hosted at the conference doing strategic reviews, which could actually provide more bottom-up stories that could help to drive more upside. So indeed, there are still opportunities out in the market, JP.
Adi, what about currency risk? And perhaps if this is, contained or manageable as long as it's not too volatile short term. But I mean, if we're talking about a currency that depreciated like 60% versus the US dollar over the past decade, that impacts investment returns. Does that somehow keep foreign investors at bay, or are they looking at the interesting fundamental stories and fiscal drivers to get into this market at the moment?
Right. I think people are less worried about the currency at the moment. Obviously, the XY has weakened almost 10% year to date, so that helped EM currencies, including the rupiah. Our trade surplus is still strong, almost 5 years in a row, consecutive months as well. So I think, people are watching closely how the government policy execution and fiscal progress could drive the further macro recovery. And on top of that, obviously, we want to see bigger FDIs into Indonesia, right? Also on the back of the new sovereign wealth fund, Danantara. And then new investments on the back of the deals with the US and even the upcoming agreement with Europe on the Comprehensive Economic Partnership Agreement that could basically drive more deals with the Europe and also investments as well.
Ari, it's great to have you on. Thank you so much for coming in this morning to talk to us. And that was Ari Yaya from Macquarie Capital. And of course, my thanks to JP for taking part in this interview as well. Marty?
All right, last look at markets before we go. Take a look. This is how we're shaping up. Get you the lay of the land, a snapshot. Lead from Wall Street, not good. And we are seeing that negativity playing through out here into Asia. Take a look at Tokyo, case in point. It's down more than 1.5%. Korea is even worse, down closer to 2. Taiwan is down more than 1.5 as well, up 1 3/4. Hong Kong, almost a half an hour into trade, is down 0.4 there right now. So the picture not pretty. All right, that is going to do it for this midweek Wednesday edition of Squawk. I'm Martin Soong at the SGX.
And I'm Chery Kang in Hong Kong. Thanks for watching, and we'll see you here, right here at the same time tomorrow. Stick around for the China Connection.